Easier or tougher? Chip stocks in the US rallied on the expectation it could be easier. Maersk is in focus as well, the global shipper, downgrading the global container volume estimate for the full year. Also downplaying Red Sea optimism, which is interesting. That moved the shares lower yesterday. And Puma in focus as well. They're keeping their guidance, but, of course, that excludes any impact of tariffs, Guy.
Yeah, that seems to be the story. Which way do you go? Okay, here we go. Start of the trading picture for Europe this morning. What do we focus on here today? Is it the trade narrative? Is it the trade deals? Is it the single stocks? Is it what is happening with some of the bigger picture sectoral stories? What's happening in pharma? What's happening in the chip space? FTSE 100 is up a little bit this morning. We're up by 0.2%. The IBEX is down a little bit. Net when it comes to the indices here in Europe, I don't think we're going to see much movement. There's a lot of kind of differing forces at play here, but do they pull in the same direction and move the market in one direction, or do they pull apart and therefore maybe the market actually at a headline level doesn't move very much? CAC's up by 0.3%, FTSE's up by 0.3%. No discernible UK trade story, therefore, to be seen in the FTSE 100 versus the French market or the Stock 600. The IBEX is a little bit weaker, which I think is interesting. We'll wait for the DAX to open up. I think Rheinmetall could be a story that we're going to be focusing on as well. We've got obviously Infineon to look at and Puma in that market. So I suspect it may take a little while for the German market to get going this morning, Chrissy.
Absolutely. When you look underneath the hood, as we await some of that German volume to pop up, I think the contributions and your biggest weight to the upside and downside tell you the story this morning. And we discussed it at the top of our show. ASML is your biggest index contributor, higher by about 2.4% this morning. Novo Nordisk is your biggest dropper. Now, this is not a uncommon story. These are two major heavyweights. But the fact, Anna, that chips and tech seem to be leading, this is in the context perhaps of the chip curbs, however temporary they may be from the United States. But then also, I think, Guy, you've spoken about this as well, the pharma story in the U.S., perhaps Novo Nordisk taking a page out of that playbook, despite its fairly
Astra's
optimistic.
down as well.
Exactly. So healthcare on the back foot, perhaps following that lead.
Yeah, Astra, Roche, Novartis, all down this morning. So it does look as if we are seeing a feed across from that idea that maybe Trump wants to lower Medicaid drug prices. And that's feeding into what we're seeing here in Europe as well this morning.
Yeah, and that'll be the second day in a row we've seen big moves on some of these big pharma names as a result of news flow coming out of the United States and the Trump administration. Quick word on ex-divs, because we have quite a few ex-div. I was confused for a moment by what was going on in the auto space, but Merck is ex-div and Renault ex-div, so let's keep that in mind when we look at what's going on in autos. But to your point, Kritty, it is the technology sector that's doing okay this morning, and some of that will reflect that chip story out of the United States. I still find that amazing that the chips rally on the back of expectations of a change in chip export policy from the United States. We don't know what it's going to be replaced with, and it's hard to imagine that President Trump is going to rip up Biden's rules and allow all chips to go to China.
That is a tough thought to swallow, but look, timing is everything here. We don't know what the temporary reprieve may actually look like. We should also mention that I think one of the top kind of volume movers this morning is AB InBev. So we've got one eye firmly on that as well, higher by 3.8%. Some of their earnings offsetting volume issues that they've been dealing with. But look, there's a lot to digest here from the geopolitics. Dare I say the Federal Reserve as well? Who better to bring it all together? Helen Jewell, who is the CIO for Fundamental Equities at BlackRock, joins us around the table. Helen, a pleasure to have you on the program, as always. What do we do here with trade deals, with Fed policy, with the kind of domestic policy coming out of the States this morning from a market perspective? It feels like it's the domestic policy in the States that's moving European stocks more. Is that a misstep? Is that a fluke?
Yeah, great to be here as always, especially on a day like today where there's so much going on. For me, the starting point is always looking at the things that we do know. And so the earnings is always where I start. Now, it has been a really quite strong earnings season. And I know earnings is backwards looking. It's Q1. But the earnings season was very strong, both in the US and in Europe. The important thing about the earnings season, a lot of that was driven by margins. And that is really important for the amount of capacity that some companies, some sectors, not every single one have, to absorb some of the narrative that we're hearing. Now, in terms of then second-guessing where things may line up, we're seeing quite a lot of intraday moves. We're seeing it already this morning. But for long-term investing, I think we have to kind of ignore that part of the noise and just focus on the facts. And at the moment, there is, again, this real resilience in earnings. Yes, some nervousness around guidance, but we're starting from a point of resilience, and that's really important to remember.
So when you're going through these earnings reports, and we've been talking about this around the table, just the verbatim that is being used across these companies, the word guesstimate was used for Infineon, for example, this morning. We're hearing BMW come out and talking about baking their assumptions on tariff reductions by July. That was the conversation yesterday. When you talk about the verbiage that is perhaps creating confidence for investors, what does that look like from an earnings point of view?
So the thing that we're always looking at is where is there less certainty in the market? And there has certainly become less certainty in this market. I am nervous about the multiple. It's something that I'm talking a lot about. It seems incredible to me that markets are pretty much where they were the day before Liberation Day, which is the day that I was last here, funnily enough. It's pretty much, if you look at it, if you were here and then here, it would look like nothing has happened in the last kind of 5 weeks. However, when you actually look at the earnings numbers, yes, there is some nervousness, but companies have been very good at setting out where they see scenarios. They've actually been very good, as Guy said this morning, at really putting scenarios around what might happen. And for us as investors, that's actually quite useful because you can map out likelihood, you can put some probability around those earnings, and that actually gives you some robustness to hang your estimates around. The multiple, however, is where I still can't quite understand why we haven't seen some kind of derating given the level of uncertainty that we're seeing. And that's something from a puzzling perspective that I'm trying to really understand. Now, that maybe is because there's an expectation of rate cuts coming down, and rate cuts coming down is relatively a good thing for multiples. But that's the bit that's really puzzling me at the moment, more than necessarily really trying to navigate too much in the earnings piece.
So where do you see, so the European discount, is it still historically high, Helen? Is it still, is there still further to run, I suppose, on that European trade?
Yeah, so the discount is still much higher than relative. So relative and historic, it's around 20. It's running about 30-35%. We got to 45% last year. So there still is potentially further to go in the discount. But the absolute level looks pretty full. It's about 14 times. That's around the historic average for Europe. It's more that the US is still slightly higher than what you expect from historic average. So it's not that the Europe is cheap per se, but the discount is wide. The area that is relatively low, and we must talk about today, is the UK. The UK is still trading at a discount. We've obviously got potentially trade cuts, trade negotiations coming through today, and likely rate cuts as well today. I was listening to Guy, and I'm kind of confident.
Don't do that. Never do that. Ever do that.
And I haven't got my screen in front of me, so. The FTSE 100 is maybe not where we should be looking for that, but the FTSE 250, exactly. Now, I haven't got my screen, you guys have, and you're probably about to tell me that the 250 is down. But the 250 is perhaps more likely where you will see benefits of any trade negotiation and rate cuts coming through.
Well, it's up 0.5% versus the FTSE 100 up 0.2%, Helen, so you win.
Well, I mean, let's see where it goes today. But the FTSE 250 has been at such a discount. Small cap names trading in the UK at 5-6 times. A rate cut with trade. I mean, let's not forget the FTSE 100 is a big services index. So how much can it really benefit anyway? Yep. We said it was a beneficiary of not being part of it. We can't have it both ways and now say it's a winner if we see the trades coming through. But I think the catalyst of Bank of England, and if what we're hearing is right and it is the UK, maybe we'll take people to have a relook at the UK, and the UK is trading at a real discount to Europe and the US.
It's interesting to see the component parts, actually. Aston Martin up, one of the car companies that will potentially benefit from a trade deal coming through. I know JLR have recently restarted shipments going out to the United States. Defender, etc., are selling really well out there. So Aston up, Renshaw's up, Harbour Energy is also trading a little bit higher. I just want to draw everybody's attention to what we're showing on the screen as well, just to give you an awareness of what you are seeing on the screen in front of you. That obviously is the Kremlin, Xi, Putin. The summit is taking place. This obviously marking the anniversary, the 80th anniversary of the end of hostilities at the end of the Second World War. But this is obviously a pivotal moment as well for current conflicts as we see how these two are going to interact, both on the trade front, but also in terms of how solid their relationship is around Ukraine and other issues that are currently dominating the geopolitical agenda as well. We will continue to monitor what is happening with this and bring you any headlines, but certainly the pictures coming out of the Kremlin, just worth a moment and a little bit of a pause just to take a look at what we are seeing there. And let me come back to you on the markets as well and talk a little bit about another aspect that I've been hearing about this morning, and that is foreign exchange. The euro has appreciated. I was talking to the Infineon CFO first thing this morning. They've plugged in, they used to plug in 105 to their numbers, they're now plugging in, I think, 112.50 into their numbers. There's upside potential for euro dollar. He was telling me that in terms of their revenue line, it's a 25 million hit every time you see a 1 cent move in terms of the euro dollar exchange rate. Is this an easier thing to calculate? Is this an easier thing for investors to fold in? If we assume, and many of the foreign exchange people that join us around this table this morning are assuming that we see a stronger euro going forward.
Yeah, so, I mean, I think where we look at this is it's not trying to get the exact number, but it's looking at those companies that are most exposed, exactly. So what's really important when you think about what's happened in the European market year to date is it's been the domestic players that have basically won, both because of the trade, but also because of that strengthening US dollar, the weakening US dollar and the strengthening euro. That is how we kind of look at this. This isn't about trying to work out exactly what that number is going to be. It is saying which are the companies that are least exposed to these kind of FX implications. And that is why I think another reason that we are seeing a lot more of these domestic players are the ones that are winning. In the infrastructure space, infra's done very well. Of course, defence has done very well. We've seen it in European banks. They are the ones that are winning year to date. So a lot of people will say to me, you know, yes, you must be really happy. Europe have done really well versus the US year to date. Actually, in terms of portfolio positioning, unless you are positioned for those domestically facing companies, you actually haven't necessarily had a great year to date. So that's how we think about it. We don't try and get the point right. It's the direction. It's understanding the exposure.
But to that wider point about how indices have performed, if you're a US investor, the DAX is up 27% year to date. For a domestic investor, it's up by 17%. The IBEX is up by 26%. Does the euro just encourage and turbocharge a move out of the United States by US investors, by other investors into Europe?
So you would think so, wouldn't you?
Yeah.
I mean, on paper, that should absolutely be the case, but that isn't actually what we've been seeing so far. The narrative very much has been, for European investors that we speak to, over 50% of them are planning to increase their allocations into Europe. You ask the same question of US investors, you get quite a different answer. It's more like 20%, even though that dollar story means that you would think it was something slightly different.
Yeah.
That is something that is puzzling to me. We're certainly hearing a bit more of an out-of-US story from US investors, making sure they dial down any overweights. But we're not necessarily seeing at the moment from US investors the kind of flows into Europe that I would anticipate seeing. Now, if we see the euro continue to increase and strengthen, I would think that has to change. And again, that might be another catalyst. But I'm going to be honest with you, Guy, we're not seeing it really in any shape or volume at the moment.
Helen, great to see you. Thank you very much indeed.
Thank you, Guy.
Always a pleasure. Helen Jewell, always joining us on an exciting day. EMEA CIO for fundamental equities over at BlackRock. Call 6 looks like this. Let's just talk you through what we're seeing in some of the bigger moves that we are seeing around Europe. As you can see, a broadly positive picture. Some weakness in pharma, though. That is interesting, given what we saw overnight out of the United States as well. Joe's got more. Plenty to talk about this morning. What do you got?
So AB InBev looking really strong out of the gates this morning over in Belgium. The company reporting much better than expected earnings, actually around double what analysts were expecting in terms of the earnings growth. The company pushing its drinking client base towards the premium brands, according to analysts today. That's where the growth is in the premium beers, but also the general beers like Budweiser, Stella, not looking too bad either for that one. Then in terms of AP Moller Maersk, that one was a little bit volatile in the open, was actually marginally higher, but now significantly lower. The company downgrading its outlook for the container market. It was actually, last time it reported, expecting a little bit of growth, now saying that it could be a year where we see a decline in the outlook for the container market. So that is weighing on stock, already down significantly, of course, this year, given the trade impact. Then over in UK retail next, holding up pretty strong. They are saying that their full price sales is where they are doing well at the moment. So not having to do discounts to get us all into the shop, get us all spending. They are saying their full prices in terms of their products doing well at the moment. So next gaining around 1.6% in London this morning. Then in terms of chips, it's a mixed one in terms of the sector today, but Infineon actually gaining. So we're up around 1.4%. That one was actually called a little bit lower. So essentially this is the broader impact coming from this news in the US of the Trump administration potentially going to rescind some of these Biden-era curbs on the sectors. That does seem to be counteracting the weakness in Infineon today. Also saw ASML was a little bit higher earlier, as we saw on the previous screen from Guy as well. Then in terms of Siemens Energy, another green one on the screen. Lots of green in terms of the earnings today. Siemens Energy looking strong on the power unit and also the renewables business as well. But a lot of this is focusing on data centers at the moment. We've seen weakness in the sector given concern around cutbacks in capex on data centers, but potentially a bit of a relief rally for that one today. Then finally, we will finish on pharma. Another negative day today. There we've got Astra, Glaxo coming down, some of the other stocks as well. Now this coming, of course, on the news that has been discussed on the show already in terms of potentially Medicare pricing in focus in the US. Trump potentially looking to rein in the prices according to a report that was in Politico last night. Another negative day for pharmaceuticals given the sell-off yesterday. AstraZeneca leading the clients down 1.6% in London today.
Joe, thank you very much. Joe Easton from our equities team. Coming up on the programme, German appliances giant Bosch releases its full-year earnings and warns of turbulence ahead. We will speak to the CEO next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
"18 minutes into the European session, we focus on what is happening in Moscow, where we have the Vladimir Putin, Xi Jinping meeting taking place. As you can see, they are now in the room on either side of the table. The Russians are on the left, the Chinese are on the right. I'm not talking ideologically here, of course, but that is what we are seeing at the moment. Some commentary coming through from Vladimir Putin. This is a critical meeting. Ostensibly, they are here to commemorate, celebrate the end of the Second World War. But obviously, this is a critical meeting in terms of how these two fit together economically and in terms of the geopolitical narrative that we see, how that develops going forward from here. They've talked in the past about how strong their ties are. Are those ties as strong as they once were? We will continue to monitor what is happening at the Kremlin and continue to keep you updated with that story. But let's return now to what is happening on the corporate front, and the corporate front in Germany, which is very much front and center this morning. The German appliances giant Bosch is reporting a 1.4% drop in sales for last year. It's warning challenges this year due to, quote, global turbulence. The company's CEO, Stefan Hartung, joins us now. Stefan, good morning. Thank you very much indeed. It's a great pleasure to speak with you today. You're still aiming, and I'm reading from your statement here this morning, you are still aiming for a margin target of 7% in 2026. But you see this as extremely challenging, extremely challenging task in view of the global upheaval and, above all, significantly stronger competition that you're seeing out of Asia. Stefan, how much visibility do you have right now in order to set targets for the business, given the uncertainty that we see around the world?
Yeah, thank you for having me on the show. I mean, obviously, after 24, we are all a bit more humble. 24, we thought we are having a year where we see the turning point of all the economies in the end of the year, but we had to realize that's not coming. So 24, we got no growth. We got a shrinking situation for us, minus 1.4%. 25 now again, we had a good start, so good momentum. All the strategies are in place for growth, for technology, for the markets, great offering. On the other hand, we have to be cautious because we know there is uncertainties in the markets. There is not yet the full momentum there. And hopefully this year we will see at the end of the year the turning points of economies like industry, like automotive, like also appliances for the consumer goods. And that's giving me actually strategically a clear backing that our focus on technology and offering is right. However, we have to be cautious that we don't overestimate our luck.
Okay. Let's not overestimate our luck. That's probably a good starting point. Be humble. Stefan, how are you dealing with the tariff story? What are you doing? How do you think about it? How are you maneuvering Bosch around this story? How's it affecting you now? Is it affecting you now?
Now, the tariffs are obviously transactional costs that are hindering trade movements around the world if they come. And therefore, tariff changes, wherever they come from, whoever is putting tariff policies into place, are significant to us. On the other hand, we have to be very cautious that we don't take every announcement for something that stays forever. We have to wait and see what actually takes place and how it's having effect. Therefore, I see it very much in a position that I don't overact on this. I don't over-exaggerate the effects. I rather see what is the conditions I'm in right now, what can I do, how can I also contribute to making transparent what the consequences are, how can we do the right steps? And by the way, we always have been a global position company with local for local activities. That also plays a bit into our pocket that we have this strategy. But let's be honest, world trade is always good for us.
Stefan, when we're talking about navigating the tariff story, as you mentioned, how much visibility or flexibility do you have to absorb the costs yourself as opposed to pass them on to some of your customers? Have you talked about that? And what does that relationship right now with your customers look like in terms of passing on those costs?
Well, that's one of the major questions. It depends on how sustainable the situation is on tariffs. So if the tariff stays, then obviously you have to move and see where actually it's covered, because you can't just cover it yourself. On the other hand, you have not over jump to it. So if you act too fast and too fast acted on prices, for example, then you destroy demand, and that would also be a problem in the situation. Therefore, it's something you have to be cautious. You have to talk to your customers, and the professional business is different than the consumer goods. And in every market and every situation, that's different. So it's pretty much a tactical thing right now. It may become a strategic thing, but so far for me, the strategic guidelines for the companies, so invest on AI-related technologies, invest on, for example, silicon carbide in the US, buying companies like Johnson Hitachi, the home HVAC business in the US. These strategic directions stay the same wherever the tariffs go. That's in this way unrelated.
I heard you talk about investing in the United States. Expand on us for us, if you can, around those plans and what that looks like. A lot of your peers, and a lot of course, CEOs in Europe are looking at these tariffs down the pike and saying, we need to invest in our manufacturing capability and basically lean into the Build in America story. Stefan, are you hopping on that train of thinking? And if so, how expensive can that get, and how quickly?
Well, we have been there before, because we have a good footprint in the US. We have also a substantial footprint in Mexico. So therefore, the Mexico-US trade relationship is very important also to us for the whole automotive industry. But we're also having already before initiated big investments in the US, like, for example, the silicon carbide fab we are investing in California. Like, for example, the investment into companies. We bought multiple companies in the US. The biggest one is the $8 billion acquisition we want to close this year for the HVAC business of Hitachi and Johnson Controls. And we are investing, or spending, you could say, in consumer awareness. So we have started a Super Bowl campaign first time to sponsor our consumer business, because, let's be very honest, the US consumer is a primary market for the world, whatever it takes. So it's very important for us to be represented and well represented in the US.
Stefan, just briefly, you say global, trade is good for you, even if you have been local for local. If we are in a less globalized world, though, to Kritti's point, how much more expensive is a less globalized world?
Well, that's hard to say. The problem is that if it's less globalized, it's probably a bit smaller, because the markets will shrink a bit. And that's actually something which you don't want to do. And obviously, you don't want to have double work. The double work would be on the development side. The shrinking of markets is actually something you don't want to see. So therefore, I also believe very much in trade relationships and in actually trade acts. So there will be, I think, we will see the first deals made in hopefully this week, and then on the next weeks, hopefully more. So at this point then, when the trade deals are done, then we will see what the final situation is. And I believe in many areas, the world will fully collaborate and have a bit different conditions, because let's be honest, there has to be a level playing field. That's also important for us as a company. And that has to be sorted out by politics. So then we can see exactly what is the situation.
Stefan, thank you very much. Thanks for your time. Stefan Hartung, the CEO of Bosch. Coming up on the programme, we will pivot back to some of our top stories this morning, where, in fact, the monetary policy and the trade outlook come together, because the Bank of England is expected to cut rates today. But could a potential US-UK trade deal have any impact on their thinking? Maybe not for today's meeting, but in terms of the outlook they give us, they probably know as little as everybody else does about what is in this broad framework between the US and the UK. We'll get back to that conversation, though, shortly. This is Bloomberg.
case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer's not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome back to the opening trade. Some breaking lines crossing the Bloomberg terminal at the moment. Sweden's Riksbank leaving the policy rate at 2.25%. The estimate was as expected to leave it unchanged. The content here is crucial, though, because, of course, in just about 30 minutes' time, we're going to hear from Norges Bank itself, which is also dealing with the same policy uncertainty that the Riksbank is talking about as well. Right off the bat, the Swedish central bank is talking about a slight easing of monetary policy going forward, something Bloomberg Economics had predicted as well. But remember, the Riksbank has cut quite a bit recently in a way that its peer, its Scandinavian peer, Norges Bank, has not. So we'll see what the kind of the line is and the commentary is from both these banks in about 30 minutes' time.
Yeah, interesting from the Riksbank then. Inflation yesterday coming in below estimates at a 14-month high, though. So interesting that we get this. Still no change from them. Let's pivot from the Riksbank to the Bank of England. The BOE is expected to cut interest rates by a quarter point today. Our UK correspondent Lizzie Burden joins us now from outside the BOE. A lot to talk about this morning. Things we foresaw yesterday and things that are a little newer on the agenda. Lizzie, could a potential trade deal between the UK and the US, much talked about overnight, could that move the needle for the BOE, and over what timescale?
Well, spare a thought for Andrew Bailey having to deal with this spanner in the works, Anna. But I've been speaking to economists this morning, and they say it probably won't move the needle much for the Bank of England. First of all, because they've already voted when it comes to this decision. But further out, the picture doesn't change much. It doesn't look like that 10% baseline tariff is on the table for this deal, though we're yet to see the scope of it. Even if they got this 25% tariff on steel and autos removed, it's still an elevated uncertainty environment globally, and that means that you've got lower global demand, lower oil prices, disinflationary, and unless this deal opens the door to more deals, especially one with the US and China, that remains the case. You could still have China dumping Europe, and the UK included in that, with cheap goods, disinflationary. So it remains the case that Trump's tariff war is set to, and there's a growing consensus about this, hamper growth and inflation here in the UK, hence why it's fully priced, unanimously expected by economists that we get a quarter point cut. The focus is on the signalling around it. Do we get at least one member of the Monetary Policy Committee voting for a half point move today? And when you look at the guidance, do they drop the language that the rate path ahead is gradual and careful? If they drop gradual, it could signal that we're on the path to a June cut as well, and that would be the first back-to-back cut since COVID and the financial crisis before that. A very, very different mood music from what we heard from the Fed last night.
Lizzie, thank you very much. Our UK correspondent, Lizzie Burden, there. And nodding as we were listening to Lizzie, our guest on set, Bruna Skarica, UK economist at Morgan Stanley. Finding something at least to agree on there, Bruna. Let's deal with the trade news. I mean, none of us can know exactly, we don't know what's in this trade deal, or is it even a trade deal? Is it just some sort of loose framework, outline? We'll have to wait and see. But what will you be watching out for that'll make a difference to the way that the UK economy performs?
Sure. So as Lizzie was saying, I think one thing to look out for is what happens to the baseline tariff. The expectation, I think, is that the 10% remains, which is still higher than the average effective tariff on UK imports into the US prior to quote-unquote Liberation Day, which was around 3%. And then I think there's an additional uncertainty around what exactly happens with the auto sector, whether we're talking about a reduction in that 25% tariff or whether it's a quota system where a certain proportion of imports are introduced under a lower tariff and obviously the rest under 25%. Yeah. So that can make a bit of a difference as well.
Can we really call it a trade deal if we see cementing of higher trade tariffs than were in existence 6 months ago? I mean, that doesn't sound like what the trade deal was supposed to be about 5 years ago.
Well, sure. I mean, the U.S. trade policy has shifted a fair bit since 5 years ago. So I think the UK here is trying to really push for a best possible outcome within the framework of this new trade policy and the new U.S. administration. I think it will be interesting to see what happens on the services front as well. Obviously, on Liberation Day itself, services were not in scope of any announcements, but recently President Trump has talked about tariffs on film as well. And it's really the services sector that is important for the UK, of course, about 2% of GDP, services trade surplus with the US. So it's important to monitor that as well moving forward.
The Fed's in a bit of a bind. It's worrying about inflation and it's worrying about employment and basically growth. And it's got a risk to the growth side and it's got an upside risk to the inflation side. What's the inflation outlook in the UK looking like at the moment? How challenging will that be for the Bank of England?
Well, it's looking much better than about 3 to 4 months ago. So one thing that we're expecting today is for the Bank of England to meaningfully reduce their inflation forecast in the very near term. So where at the February meeting, for example, we were talking about inflation peaking close to 4% in the third quarter this year, we actually think they'll be forecasting something around 3% into year end and potentially 2% for this time next year. And that's all oil and gas. So that's how that kind of slowdown in global growth features in inflation.
Okay, so we park inflation to one side. Inflation's now going to be behaved. We can take that, because that was a big risk for the Bank of England, that we stayed with sticky inflation. Is there therefore an argument that you want to go more aggressively at this point? If you don't want to worry about inflation and you do need to worry about growth, is there an argument, which I suspect the Fed would like to do at the moment but can't, focus more on growth and actually deliver some fairly big cuts at this point and reduce rates fairly quickly? Are we at that point where you actually need to deliver those bigger cuts?
Well, certainly, I think the broader context matters. I mean, we just saw Riksbank, for example, remaining on hold, but they had cut quite a lot.
Yeah.
So the Bank of England has really cut less than its peers. We're talking about very restrictive monetary policy. And there is a question to be asked about, really, do we need to stay this restrictive if the slowdown in global growth will do a little bit of that heavy lifting in terms of reopening the output gap and allowing for that sustained inflation at 2% target? So I think the question is definitely there to be asked. And I think a couple of MPC members today, their answer will be, actually, we should be a bit more aggressive. And I think 2 members at least could vote for a 50 basis point cut.
How much of that heavy lifting, as you put it, is being done by the markets, and specifically not just the volatility over in the States, but this giant move you're seeing in cable that's staying above, I believe, 133, the move you're seeing in gilts as well? How much of that is doing the work for Andrew Bailey?
Well, there's a lot of moving parts, of course. There's obviously the commodities price complex. Then we have cable, as you rightly mentioned. I mean, sterling effective exchange rate is up since the February meeting as well. We're a small open economy. The FX pass-through to inflation is quite large, certainly larger than in the euro area. But of course, we did have a pretty big repricing in the bank rate as well. So I do think that when it comes to growth revisions, we do think growth is going to be downgraded in this set of forecasts, but perhaps not as aggressively as most think, because ultimately you did have about 40 basis points of repricing in the front end of the UK market, which obviously helps growth 2 and 3 years down the line. Yeah, absolutely.
So Guy mentioned the predicament of the Federal Reserve right now, and there's a question, and I think this question has been around for some time, but especially in the last 24 hours, which is how quickly can the Federal Reserve pivot? Should they need to make a real sea change in their commentary? How quickly can they react? Something that the BOE has historically been very good at in being reactive. Talk to us about what that secondhand ripple effect looks like. If the Federal Reserve changes tune, how affected is the BOE?
I mean, I do think that it is a different kind of state of the world, because over in the US, we are talking about them introducing tariffs. It's a bit like a supply side shock. So you're stuck with higher inflation and slowing growth. So that's exactly what Chair Powell talked about yesterday. So the risks to the mandate are to the both sides. So higher unemployment, higher inflation as well. In the UK, my view is that this is purely a disinflationary shock for the UK. So we're talking about a hit to demand. We're talking about potentially lower inflation, not just from commodities prices, wider output gap, but also, as Lizzie mentioned earlier, potential dumping of China goods into the UK. And so in that sense, I think the Bank of England themselves can be a bit faster in cutting rates than the Fed. Indeed, Morgan Stanley's house call for this year is for no cuts from the Fed, which is obviously very out of sync with where the market pricing is for the Fed.
Bruna, back to where we started the conversation, and specifically today on the Bank of England, I'm going to be hosting some special programming, of course, around the Bank of England announcement. Help me understand, gradual and careful, how I should interpret their presence or absence.
Yeah, absolutely. Gradual, careful, cautious. So the February guidance was quite an interesting one. So I think what external member Taylor said at the Treasury Select Committee, he said, well, the way the markets understand gradual is as, 125 basis point cut per quarter. And I think that's certainly how the average market participant takes it. For the Bank of England, perhaps that might mean we're not really looking to do sizable cuts. We're looking to be fairly, careful. So
it means not June.
In terms of, well, I would say that that's how the market would certainly understand it. If that guidance remains in place, I do think the pricing for June would come down in terms of the odds of a cut.
Okay. Bruna, thank you very much. Bruna Skarica, UK economist at Morgan Stanley.
Okay, what do we got coming up for you? We're going to return to the corporate news. We're going to return to Germany. The German chipmaker Infineon cutting its outlook, blaming tariffs uncertainty. It's also got an FX story to fold in as well. My conversation with the CFO next. This is Bloomberg.
Because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person to not manage that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. in the US, you put on tariffs, these things can be inflationary. And there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. About 43 minutes into today's session, green on the screen across the board. Outperformance in the DAX, higher by 0.7%. Now, that's largely going to be an earnings story. We've seen some decent numbers coming across the board, despite one key theme, which is simply this. People are worried. We don't know what the future looks like. And yet, positivity beats across the board.
Yeah, there's some interesting corporate stories that I think are really nuanced this morning. Infineon is definitely one of them. So Infineon stock is up by 2.43 this morning. Let's call it 2.3%. The reason for that is actually, I think, probably more to do with what we're getting out of the United States than rather what we're necessarily getting out of what the German chipmaker is telling us this morning, because Infineon has cut its outlook. Basically, it's warning of a potential hit from tariffs. It doesn't know, but it's kind of folding those into its numbers. It's also flagging as well some fairly significant currency fluctuations. So let's talk about the kind of the former rather than latter. We'll come back to the latter in just a moment. Let's talk about the trade impact on Infineon and what is happening with the tariff story. I caught up with Sven Schneider, who's the CFO.
We do not see anything of a tariff impact in our numbers yet, number one. Number two, we do not get any feedback from our customers, which leads to that belief. So that's the baseline. Now, there are two things which we had to deal with and which we have baked into our forecast. The first one is currency. The dollar is much weaker. We had previously guided for 105 euro dollar. Now it's between 110, 115. Honestly, I don't know where it will be. So we just took 112.5 as a midpoint. That gives us a give or take 400 million revenue headwind in the second half. And then there is the tariff uncertainty. And I repeat and stress the word uncertainty. We believe it's likely that there will be a negative impact on demand in the next quarters, although we do not see it in the numbers yet. And therefore, we have made a guesstimate. It's no calculation because we don't have the data. It's a guesstimate of a potential impact. And we guesstimate that at 10% of our Q4 revenues, which translates, give or take, into 400 million. So if this is coming, yes, then we include that in our guidance. And then the guidance compared to last year is slightly below, indeed.
Sven Schneider, the CFO over at Infineon. How frustrating must it be for a CFO that basically kind of speaks Excel, spreadsheet, etc., that not to be able to actually know, not to be able to forecast, not to have a clear understanding of what is happening yet, because you're not seeing the evidence, you know it's coming, so you can't quantify it. I remember talking to the CFO of Airbus, talking about kind of, they have visibility on contract by contract, and they can see the drop down, but you have to know what the effect is to start with to understand what you're going to see in terms of the bottom line on every single contract.
Yeah.
It must be really frustrating for these guys. They don't know at this point.
Yeah, you know something's moving, but you're not entirely sure what.
But you don't know what it is, so you can't start at the top and work out what the hit at the bottom is.
I thought it was interesting talking to Bosch earlier on and thinking about that tariff uncertainty. He was saying they're assuming that they don't all stay, but what assumptions would you make?
Yeah.
You know, you're operating in the dark, and don't overestimate your luck. Don't overestimate how lucky you're going to be, was his guidance. So maybe as a CFO, maybe as a sort of cautious by nature
so
CFO,
we're talking about luck now.
You don't overestimate your luck.
It's fascinating, though, that's exactly what BMW said as well, in that they are expecting these tariff reductions. And it's kind of the vibe that I think we had heard from the Trump administration, perhaps not in the car-making space or in the airline space, but also in the chips and the AI space as well.
Yeah, absolutely. Bloomberg has learned that the Trump administration plans to rescind some Biden-era AI chip export curbs. This comes as the US and China prepare for trade talks over the weekend. NVIDIA and AMD gained on the news. It also comes ahead of President Trump's visit to the Middle East, which could be crucial on this front as well. Let's bring in Bloomberg Intelligence senior analyst Robert Lee. Robert, help us understand the direction of this policy. What has prompted the policy reversal on Biden's plans and now replaced with some uncertainty?
Okay, well, President Biden's plan was arguably a little bit rushed. It was announced in the sort of dying days of his administration. And it met with quite a pushback from US players, including NVIDIA, of course, and also from some third-party countries, particularly in the Gulf region, which are, on good terms with the US, countries like Saudi Arabia and the UAE, which maybe got caught in the middle. So I think the whole policy needed a bit of a rethink, and that's what Trump and his administration are looking at the moment. So I guess we'll see what they say over the next week. And as you mentioned in your sort of prelude there, Trump is actually taking a trip out to the Gulf region in the next week or so. So maybe that's coincidental or maybe deliberate timing on this front.
Talk to us about how that shows up for China, though. I mean, we've heard this narrative so many times, Robert, simply that every time the U.S. pulls kind of technology from another part of the world, the other parts of the world are then forced to develop their own and potentially better. Is this ultimately a positive for Chinese tech?
I think it might bring Chinese companies some short-term reprieve, but the direction of travel is pretty obvious. Global AI is a two-horse race at the moment between the US and China. Plus, you've got all the additional ongoing geopolitics, tariff wars, etc. China is the main economic rival and, a growing power on the global stage. So I think whatever happens, the US is going to go out of its way to make things difficult for the Chinese AI sector, reduce its access to leading-edge semiconductor chips, and also leading-edge semiconductor fabrication equipment. The US is going to do anything it can to forestall Chinese technology developments, whether that technology is going into military or security apparatus or going into the mainstream sort of consumer sector. So this is an economic war.
Robert, just give me some winners. Let's make this simple. Investors are watching. They're trying to figure out who the winners and losers are going to be from all of this. Who do you think? Give us some names.
Okay, well, the obvious one has to be NVIDIA, but obviously it's not clear how things will play out at the moment. I mean, there has been some chatter, if I can put it that way, here in Asia, that NVIDIA is looking to alternative routes to access the China market. And I think Jensen Huang himself did say, in fact, this week, that he thought the hardware opportunity within the Chinese AI market was around $50 billion. So that's a massive piece of business that you can't really walk away from. And if you remember, over the last month as well, after the H20 chips were banned by President Trump into China, I think NVIDIA wrote down about $5.5 billion on that front. So it's caused NVIDIA some short-term pain, but I think if they can come up with a way that is agreeable to the administration to access this, potentially huge market, not just in China, but within Asia itself, then that could be a positive for NVIDIA. I think all I can say at the moment is NVIDIA is definitely looking at potential options, to work around this problem. So we'll have to wait and see on that front. Other potential winners, I think, again, the Gulf region, countries like the UAE and Saudi are looking to invest many hundreds of billions, even up into the $1 trillion bracket in AI. That's a huge potential market for US companies. So if they are on a more favorable footing, once we see what the new legislation is, that could be a positive for them and provide some opportunities for US chip and server companies selling into the AI sector.
Great stuff, Robert. Thank you very much indeed. Robert Lee, Bloomberg Intelligence, senior analyst covering the chip space. Breaking news out of China.
Breaking news out of China, a proposal crossing the Bloomberg terminal that China is weighing a housing market overhaul that curbs pre-sales, basically making it so that developers will only offer completed properties instead of using the pre-sales model that in the prior iterations have exacerbated the housing crisis. We know this is a real estate crisis that's been going on for several years now. So this is something that's being put on the table with, of course, exceptions made for housing projects or local governments and some leeway in terms of implementation. So we'll see if that proposal does indeed come to fruition. In the meantime, let's go back to some of the other corporates here in Europe that have reported earnings this morning. Maersk and Rheinmetall at the top of the pile, with aerospace and defense company Leonardo reporting later today. Charlie Wells, drinking out of a fire hose this morning, is here with an update. We'll start with Maersk here, because it feels like they're tackling maybe every issue on the planet right now.
I mean, look, they control 14% of the global container fleet, and I think the question had been, what view are they getting from the trade war? You guys had a great conversation with their CEO earlier this morning. Let's take a listen at a point that really stuck out to me.
The rollout of the tariffs in the U.S. So far, what we have seen is this is mostly a U.S.-China issue. The rest of the world continues unabated in the same direction as what we have seen for the past year and a half. But clearly, in the U.S. And in the China relationship, this has already taken a bite in the second quarter in April and will continue in May.
And I mean, guys, some really interesting comments there on kind of how he's viewing that kind of trade tension between the U.S. and China. What did you take away from your conversation?
A couple of things, really. One of which is he hasn't yet seen the effect of dumping back into Europe. So this idea, and you're potentially going to hear about it from the Governor of the Bank of England a little bit later on, central banks are talking about this disinflationary impulse that potentially could come out of China to Europe because product is not going to the United States. Not seeing it yet, doesn't rule it out. But it's interesting that it's such a live conversation here in Europe at the moment.
I thought it was interesting how he had a lot of questions for us as well. So we were asking him things, and he was saying, well, I don't know. I mean, how long can these companies live without inventory? How substitutable will these products be? As if, you know, that whole industry is also scratching around for anything to peg an estimate on.
And he also made the comments around the Red Sea as well, which I thought was interesting, because so much of what he's talking about is not just the trade flows, but the geopolitical situation as well. He specifically said that even though there's a temporary reprieve in the Red Sea right now, the situation in Israel and Gaza is not getting better anytime soon, and that kind of limits visibility from that situation. That defense theme, the geopolitical theme, is one that we've seen across the board.
It is with some irony that I talk about defence companies, in as much as we're talking also today about VE Day and kind of an end of a major conflict in Europe. It's not as if we are done with that as a theme, though, and that stands out in what we're seeing today from Rheinmetall, but we're also going to get Leonardo a little bit later on as well today.
It really does. I mean, so much of a lift. You know, we saw that beat from Rheinmetall, and I think the question is, if you look back even just 5 years, their share price is up. This kind of like 2,300%. So this huge uplift this year, 170%. What is the catalyst going forward, right? Is all of this baked in? All of this kind of German defense, European defense spending, we know that it's been so, significant. What is the upside for these stocks? I think we've had this positive earning, of course, but, what else is there? Is it, kind of Brussels talking more about procurement coming from Europe as opposed to kind of, the European countries buying from the U.S.? I think that's the question.
Leonardo also on deck later on today.
I mean, look, they are, they're coming up at 4:30. I think, again, this kind of defense spending lift is going to kind of play in here. They've had a little bit of change, too, in their aeronautics unit, kind of, trying to get a kind of competitive edge there. But again, how do these stocks continue to propel forward? I think that's what investors are really focused on.
Okay, Charlie, thank you very much. Charlie Wells with a quick rundown of some of the earnings stories that we have delved into in great detail and some that we have not had time to cover up to now. Let us just tell you that we have, of course, coming up the Bank of England rate decision. That is live just after 12 o'clock, a couple of minutes later, because, as Guy mentioned, VE Day commemorations mean it'll be 2 minutes after midday here. And then we have, of course, coverage of the press conference by Governor Andrew Bailey, and then an interview with him a little bit later on. You can watch the press conference, 12:15, that starts, or our coverage will start at least. That's on the terminal and on YouTube. We are also expecting to hear more about a UK-US trade deal.
10 a.m.
Eastern. We'll see.
Yeah, 10 a.m. Eastern time, apparently, is when we're going to get the news coming through. That's the idea.
That's President Trump.
Yes. I'm assuming he has some idea of what the timeline looks like.
Yeah.
So that may come up a little bit later on. But the timing is going to be interesting. The Bank of England's already made its decision. And it will already had its press conference by the time we get all that news coming out a little bit later on.
And before that, some comments, I believe, coming from Keir Starmer as well at about 9 o'clock. So we are on watch for that. And whether any comments around the trade front or, of course, any defense comments. Yeah. It's happening in 3 minutes' time.
I'm just putting all that together and telling the time.
Well, we'll see if he even addresses this at the defense conference. Unclear at the moment. That does it for the opening trade. Few stocks higher this morning. Stick with us. The Pulse is up next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Bloomberg learns that Donald Trump is set to announce a trade deal between the U.S. and the U.K. later today, while the Bank of England also expected to cut rates this lunchtime after the Fed signaled it's still in no hurry to ease. Plus, Vladimir Putin hosts leaders, including China's Xi Jinping, as they seek to challenge the U.S.-led world order. Now, a lot of the focus, of course, when it comes to stocks, will be on that trade deal between the U.S. and the U.K., maybe a template for future trade deals to come. Certainly, that's what we're seeing across the board if you look at the European markets map, but also S&P futures gaining some 0.7%. Now, the U.S., again, expected to announce this agreement, which the U.K., which could be positive for U.K. equity markets. So let's get straight to the European markets map, and then we'll look individually at some of the stocks that could move on the back of it. But look, sterling could also be on the move, possibly other close friends of the U.S. This is also positive news. For the moment, the FTSE's flat. A little better news out there for the CAC 40 on the DAX, gaining between 0.4 and 0.6%. It's very clear that market turbulence that we've seen over the last 5 weeks has certainly calmed significantly since early April, partly thanks to Trump's trade concessions, but also following a string of U.S. data that broadly says, look, investor sentiment in the U.S. is still holding up. But we're also getting some breaking news out of Norges Bank leaving its benchmark interest rate at 4.5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg understands that President Trump is expected to announce a trade agreement with the United Kingdom at a news conference later today. Now, let's get all of the details with Ross Matheson, Bloomberg's EMEA news director. Now, Ross, I mean, the rumors running wild. The market is quite excited if we get a trade deal, because this could also be good news for other allies of the U.S. But what do we actually know?
Well, it depends whether you call it a deal, an agreement, or something probably a lot looser than that. I mean, this could be quite a flimsy thing. It could be just a framework to set out the parameters for future negotiations. So this is just, in a way, an MOU for how to proceed going forward, and very broad, and covering a range of things, but obviously maybe allowing the UK to get a little bit of tariff relief. But actual proper trade deals, they take years to agree on and then to even implement after that. So this is probably going to be something quite broad. But as you say, the UK then gets first mover advantage of it. It gets to be the very first one that Donald Trump says, here, I've got this arranged and sorted. So good for the UK to be front of the list in a way. Does it set out the parameters for other countries that follow? Again, broad framework agreements, pushing all the hard stuff well down the road.
Yeah, and again, President Trump has also been speaking ahead of the U.S., trade talks with China. It feels like there's a softening of the mood, but I don't know whether that's tangible or there's just a willingness from the Trump administration to maybe try and get something done.
Well, the fact they're meeting in person is significant. I mean, we've been wanting to see them sit down and have a conversation, but interestingly, even overnight, they're still disagreeing about who initiated these talks. There's sort of this sideline drama about was it China or the US who reached out first. But by the by, they are going to sit down in Switzerland this weekend. That is meaningful. Obviously, Donald Trump saying ahead of that, I'm not going to preemptively lift tariffs on China, but you wouldn't expect him to. China today saying we would like to get some tariff relief as a goodwill gesture as part of this. But you can imagine they're going to go into that conversation seeing a general framework again of understanding. This sets the way of how they're going to talk to each other going forward. At least there is a conversation happening. It depends on how well they gel in the minute. Again, personality-driven meetings matter. So we'll see how that goes. But this is not going to produce a trade deal this weekend, but it may give us a little bit of a roadmap to how things will go going forward.
Ross, thank you so much. Ross Matheson there, our, of course, EMEA News Director. Now, the Bank of England also expected to cut interest rates by 1/4 point today, but does a possible trade deal between the US and UK actually change the path ahead of the central bank? Well, our UK correspondent Lizzie Burton joins us now outside the BOE. So, Lizzie, does the potential trade deal actually move the needle in any way?
Well, it's thrown a spanner in the works, hasn't it, Francine? But the fact is the BOE has already voted, and it's unlikely that they will vote again, especially given that the press conference from Donald Trump is likely to fall after the BOE's own press conference. This is the view of economists I've been speaking to this morning. They also say that further out, it barely is going to move the needle for the economic picture in the UK. Ros just talked about how this is probably setting up talks down the line, but more than that, it's unlikely that that 10% baseline tariff is on the table for this agreement. And if you even have the 25% tariff on cars and steel removed, you've still got a global landscape that is affected by this trade war. So I would expect Andrew Bailey, the governor, today to be still talking about this environment of elevated uncertainty. And unless this deal, if we get one, opens the door to more deals, you're still likely to see suppressed global demand, lower oil prices, disinflationary, and unless you get a deal with the US and China, you're still perhaps going to see China dumping cheap goods on Europe, including the UK. Again, disinflationary.
Lizzie, what sort of dovish signaling could we actually see around this expected 1/4 point cut?
Well, that 1/4 point cut is fully priced in by markets, unanimously expected by economists, Francine, because of the weight of Donald Trump's tariffs on growth and inflation in the UK. But that dovish signalling will be crucial. You may see at least one member of the MPC voting for a jumbo cut today, not just Swati Dhingra, the Archdove, but maybe we see Deputy Governor Dave Ramsden going for it. He's got form when it comes to pivoting the committee, and maybe we see Alan Taylor, the newest member of the MPC, going for it as well. Surely the market would take that as a dovish signal, even if Andrew Bailey says that we shouldn't. And beyond that, there is the guidance. At the moment, they're saying that the rate path ahead is going to be gradual and careful. They used the word careful because they wanted to take account of Trump's trade policy, but if they take careful away, perhaps it suggests that the risks are balanced more towards growth and a slowdown in growth than a rise in inflation. And if they take away gradual, perhaps that opens the door to a June cut as well. And that would be the first set of back-to-back cuts we've seen from the BOE since COVID, and before that, the financial crisis. So a very, very different tone potentially from the bank than we got from the Fed last night.
Lizzie, thanks so much. Lizzie Burden there at the Bank of England. We'll bring you, of course, the rate decision at the slightly later time at 12:02 today, because of the 2-minute silence for VE Day. And then for viewers in the UK, we'll also have full coverage of Governor Bailey's news conference and a special broadcast starting at 12:15 p.m. We also are listening to Keir Starmer, who's just giving a press conference on defense. He started the press conference by talking about the trade deal, but by only saying you'll hear more from him later today on the U.S. economic deal. Again, he's also just said that he will act in national interest for workers and business. Now, for more on markets, the UK-U.S. trade deal, for how the Fed is reacting to Trump's trade policy, let's bring in Bloomberg's Justina Lee and Coco Agbo-Blua, Global Head of Economics, Cross-Asset and Quant Research at SGCIB. So thank you both for joining us. Coco, thank you for joining us. I mean, there's just a lot going on, right? There's a deal, it's not a deal, maybe there's something softer. We heard also from Jay Powell yesterday. What do you think is driving markets right now?
Well, I think the market has pretty much unwound most of the risk premium after Liberation Day on April 2nd, when you look at the equity markets and some of the credit markets. But one of the key factors that haven't completely recovered are the dollar, which is roughly down 10% from its peak. You have the oil price that's also under pressure, and then in volatility to some extent. So I think the market is trying to find where the equilibrium is, and ultimately it's really around game theory. So Pareto optimal equilibrium is where both sides get what they want, and the key point from our perspective is that the current situation is not an equilibrium. So there's pressure, and the path of least resistance is in our opinion, is for a deal or a ceasefire to occur before July the 9th, which is the next key date.
Which is the next key date, and this is actually what Jay Powell also had to say on tariffs yesterday.
There's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that.
Coco, is the market too optimistic on tariffs right now? Well, too pessimistic?
Well, okay. I think there's a quote that says a pessimist is an optimist with experience. But I think markets. But I think the market is clearly more on the optimist side, trying to see sort of light at the end of the tunnel kind of situation, given how Trump has backtracked from the reciprocal tariff.
Justina, what are you looking at? Again, we could get a boost on UK assets if there's something substantial with US-UK, but at the moment it could be, an understanding that they'll work closer on certain sectors. So again, we're lacking news and clarity.
Yeah, exactly. And I think you see kind of markets kind of pouncing on any hint of good news. So we have kind of UK stocks kind of rising higher today, and even the sterling is a bit higher. And I think that kind of reflects a bit of optimism that, this is going to be, this is a trade deal that, at least in the UK's case, has been kind of a few years in the making and might be a template for other deals going forward. But I think one key consideration here is President Trump actually responding to a lot of the polls that we're seeing out of the U.S., which shows that the confidence in his handling of the economy is falling. And I think that is sort of the key point here, because at least from kind of previous, his first term, it does seem like he's someone who kind of wants to remain popular and actually does care about the markets. And, has this changed this time around?
Yeah, I guess the question is that, does that change his policies completely, or do they just lay dormant until he can reenact them? And again, the perception of the markets on that will change pricing.
Right, exactly. Because this time around, he does seem like, he's a bit more dead set on his path. And that's because sometimes it's not just about him. It's also about the people that, he's put around him. And they seem a bit more kind of like hell-bent on this path they're on. And, we're kind of seeing this uncertainty playing out, in the Fed's case, because the Fed's basically in a holding pattern because they're worried about stagflation. But for the moment, they can kind of afford to wait it out because U.S. economy still looks pretty solid. But it all depends on whether, the U.S. gets these trade deals, whether we kind of see these tariffs go back to kind of earlier levels.
And Coco, the big one is, of course, U.S.-China.
Yeah,
do you expect, the fact, as Roz was saying, the fact that they're sitting down and actually talking about it is a positive news, but what do you expect out of it?
Yeah, I think they will clearly expect some sort of gradual agreement to sort of ceasefire in terms of the tension we are in today. It is not sustainable to have the two largest economies in the world to be essentially fighting each other. So I think the other very important point is the power dynamic that's happening. So global companies, multinationals, multi-trillion-dollar companies have huge influence in terms of the political system in the U.S. If you look at how a presidential campaign, costs something like $1 billion. So these multinationals, and we see that with the CEO of Apple and all these big national, putting pressure on the White House, on Scott Bessent, etc. So I think this is pretty much what's also happening behind the scene before a U.S.-China trade deal to occur.
Yeah, and on a lot of these chief executives, earnings are a bit fuzzy because forward guidance is so difficult to give, Justina.
Right, exactly. I mean, we've heard from kind of some executives about the impact of tariffs, and they're definitely worried about that, especially in more kind of export-oriented sectors. But you're right. I mean, going forward, kind of how do you plan for that? And I think that is the challenge that we're seeing right now.
Coco, when it comes to central banks, so we heard yesterday from Jay Powell, today we have Bank of England. The Bank of England is actually getting quite a lot of pushback. Anna Edwards also messaged, I mean, she had someone from Morgan Stanley say, why are they at 4.5%? I mean, is there really, does growth or inflation get hit first, basically, because of the tariffs?
Yeah, I think as we discussed in your previous discussions, trade wars are deflationary because there's an excess supply that needs to find a home, and it will be transitory in the U.S. in terms of high price impact. But I do think central banks have a put option, and they will exercise it when they see clear evidence of lower growth and lower inflation. And I think it is the case of what we see today when it comes to service price inflation, for example. That was the stickiest part, and with the oil price going down, so the path of least resistance will clearly be for a cut. That being said, they may have to cut more aggressively if the evidence of more damage to the underlying economy is seen in the data in the next couple of months.
But it doesn't necessarily mean that the Bank of England is behind the curve.
No.
Is it cautious to be in a wait-and-see mode?
Yes, I think that's the right stance because monetary policy takes 3 to 5 quarters to have an impact on the economy. So you really need to be sure of the evidence before cutting, because if you make a policy mistake, then you lose credibility. And the biggest asset of a central bank, it's credibility.
Justina, I mean, every time I ask about gold or ask about crypto or treasuries, I mean, the behavior of these traditional safe havens Bitcoin isn't, but has been quite interesting because they've been behaving quite peculiarly.
Yeah, exactly. And one thing that's been really interesting because is for a while, during the April market volatility, long-end treasuries don't seem to be such a great hedge to stocks right now. And so I think a lot of investors are kind of wondering, what else is a good replacement? Because even hedge funds weren't doing that well. And I think that really is the debate here. And I think another key point to look at is, we've seen U.S. stocks recover, but does that mean international capital is as enthusiastic about investing in U.S. stocks as they once were? Or are they kind of really looking at Europe again because of kind of all these new fiscal commitments and maybe more investments coming to this region?
Yeah, what's your take on Europe? Again, if you look at protectionism around the world, Europe has a tricky balance to pull off.
I mean, this is why I usually quote the great philosopher Mike Tyson, who once said, everyone has a plan until they get punched in the face. So a lot of the investors we talk to are clearly seeing the fiscal stimulus and the $1 trillion plan, etc. However, the gravitational pull of the the process it takes to get anything done in Europe is something that is keeping clients and investors on the back foot. So we'll have to see whether this drives productivity growth, etc. Because, as you know, the Draghi report shows that from 2040 onwards, Europe will lose 2 million people a year in terms of demographics. So this is why essentially productivity gains, investing in digital, etc., is a matter of survival for the Euro project.
When do we know? Actually, I mean, we know that the German chancellor had a bit of a setback, digital vote, but then now he's chancellor, everything's okay for the moment. I mean, they're expecting to spend quite a lot on defense. Is it 5-6 months to understand whether Europe can really get its act together, or will it take longer?
Yeah, I think it will have some evidence over the next 5 to 6 months, because a lot of these commitments are real. So the rearm Europe is over 4 months, so this will clearly create more spending. The infrastructure plan ban in Germany is going to have clear evidence. We see growth in the Eurozone sort of stabilizing around 1%. But what we need is more kinetic energy to propel Europe to reach this sort of escape velocity from the low growth, low momentum it has been suffering for the past few decades.
Okay, thank you both for joining us. Justina Lee there from Bloomberg, Nkoku Agboblua from Societe Generale Corporate and Investment Banking. Now coming up, Bloomberg learns the Trump administration is planning to scrap some Biden-era AI chip curves. The details on our scoop next. This is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome back, everyone. Now, Bloomberg has learned that the Trump administration plans to rescind some Biden-era AI chip export curves. Now, this comes as the U.S. and China prepare for trade talks this weekend. Let's bring in Robert Lee, a senior analyst at Bloomberg Intelligence. Robert, as always, thanks so much for joining us. So what actually prompted the policy reversal?
Okay, well, the original legislation was arguably a little bit rushed. It was put forward in the final days of President Biden's tenure. And it was quite broad brush in nature. Again, I think it lacked focus. And so what Trump and his team are trying to do is obviously potentially scrap that proposal and come up with something that's more laser focused, obviously more focused on its main rival in the AI sector, which is China, and to avoid collateral damage to maybe some friendlier nations or nations which the US is on friendlier terms with and sees good opportunity to sell its AI technology into. And by that, really, I'm referring to countries in the Middle East, particularly states like Saudi Arabia and the UAE, for example.
So, Robert, could this actually be a positive for China tech?
I think in the near term it could bring some short-term reprieve, but, you know, global AI is a two-horse race between China and America at the moment. Plus, you've got the trade war and growing, you know, geopolitical tensions, to state the obvious, between the two superpowers. So I think the direction of travel remains clear. We're going to see a likely further tightening of restrictions on China's access to leading-edge technology, whether it's NVIDIA chips. And you saw, you know, a few weeks ago, the ban on the H20 NVIDIA chips in China. You'll probably see a further tightening of restrictions on advanced semiconductor fabrication equipment. So again, maybe Trump and his administration putting more pressure on ASML and European suppliers or Japanese suppliers on that front. So I think that's the direction of travel. That's unlikely to change. But again, it's to try and avoid the collateral damage, if you want to put it that way, on countries who are sort of in the middle, particularly Gulf countries. I think the UAE in particular is looking to invest several hundred billions of dollars, potentially over $1 trillion in the next 10 years or so in the AI sector. And that is an enormous opportunity for US tech platforms and US tech providers like NVIDIA. And coincidentally, I think as has been mentioned earlier in the program, Trump's taking a trip out to the Middle East in the next week or so. So I think we're going to see more headlines, I would imagine, in the coming days.
And Robert, meanwhile, we've actually had some alarm bells for the chip sector from ARM.
Yeah, ARM, when it was a UK-listed stock, was referred to as a sort of canary in the coal mine because it's involved on the development side of the chip sector. Having said that, what ARM is saying, and their guidance was at the lower end of the range, and they declined to give full year guidance. But that's a similar story to what we've heard from other chip stocks, whether it's Samsung, Hynix, and others. I mean, the world is, to state the obvious, a very uncertain place at the moment with tariffs. You've got new tariffs put on one day and then walk back the next. It's a very, very difficult environment for any company, whether they're semiconductor or elsewhere, to have a firm view, even for their own internal budgeting, let alone giving external guidance to investors. So ARM's message, an uncertain message, was not different for what we've heard from others. But obviously the stock price did take a hit overnight.
Robert, thanks so much. Robert Lee there from Bloomberg Intelligence. Now, Apple says it's actively looking at revamping the Safari web browser on its devices to focus on AI-powered search engines. Now, the move marks a seismic shift for the industry, hastened by the potential end of a long-time partnership with Google. Now, a senior Apple executive says AI search providers will eventually replace standard search engines. And the Chinese President Xi Jinping is meeting the Russian president in Moscow, where he's on a 4-day state visit. Now, China has maintained close ties with Russia despite the conflict in Ukraine, and talks between the two presidents coming amid the trade war between China and the U.S. Well, let's get more now from Bloomberg's Russia government and economy editor, Greg Sullivan. Greg, thank you for joining us. So what exactly is the purpose of this visit broadly, and what do we know about what's actually on the agenda?
Well, in many ways, this is a chance for the two sides to really demonstrate their partnership, their deep commitment to one another, and the continued cooperation that they have. Now, from the Russian side, that also helps demonstrate that they are not globally isolated, despite Western sanctions and Western attempts to cut them off from the global system. For the Chinese side, they've increasingly looked at ways to upend the U.S.-led global order, and this is another chance for that. Now, that being said, there are some concrete items on the agenda in the talks today. One will be the war in Ukraine, how talks around that are going. Another item on the agenda will be U.S.-Russia talks. This is the first in-person sit-down since Donald Trump, between these two leaders, since Donald Trump unleashed his trade war. So expect them to focus on ways that they can coordinate responses to Donald Trump or to share information about responding to him. Another item that will be on the agenda is the proposed Power of Siberia 2 pipeline. That's something Russia has long sought after, but there's been some sticking points. So that is on the agenda, something concrete there as well today.
We know that there's a unilateral 3-day ceasefire Putin has declared. Where do we stand on a longer-term truce, Greg?
Well, that's right. Early in the Trump administration, we heard a lot of talk about ending this war swiftly. We heard that the Trump administration wanted to end it within the first 100 days of the presidency. And there was a lot of talk about coming to the table and trying to hash out an agreement. But as you said, Putin has declared a unilateral 3-day ceasefire. Ukraine has not said that it will reciprocate it necessarily over these Victory Day commemoration celebrations that are being held in Moscow. But that falls far short of the 30-day ceasefire that the Trump administration had sought, or any longer-term truce. Basically, at the moment, there are a lot of sticking points. Moscow has been making a lot of demand. We've seen that the White House has actually expressed frustration. They've threatened to walk away from the deal. We've heard from Vice President J.D. Vance that potentially Moscow was demanding too much in these negotiations. So right now, they do seem to be at a standstill, and it does appear that Moscow seems to think that they have the advantage on the battlefield and that they can basically delay any kind of truce.
Thank you so much, Bloomberg's Russia economy and government editor, Greg Sullivan. Coming up, we'll be speaking to the Novonesis chief executive, Esther Baguette, as a company reports earnings. That's next, and this is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Bloomberg learns that Donald Trump is set to announce a trade deal between the U.S. and the U.K. later today. Well, the Bank of England expected to cut rates this lunchtime after the Fed signaled it's still in no hurry to ease. Plus, Vladimir Putin hosts leaders, including China's Xi Jinping, as they seek to challenge the U.S.-led world order. Now, Danish biotech firm Novonesis has released first quarter earnings in line with expectations. The company has also maintained its revenue forecast for the full year. Well, Esther Baguette, the president and chief executive of Novonesis, now joins us. Ms. Baguette, thank you so much for joining us. I mean, there's a lot going on in terms of tariffs and production and how you could be impacted. Do you have a lot of local production, including in the U.S.? Does that mean that you're 100% clear of any threat from tariffs or trade wars?
Thank you for this beautiful intro and also question. We started the year in a very good and strong mode. We delivered 11% sales growth, and that puts us in a good place of comfort. As you so nicely mentioned, we have a broad global footprint with also strong presence in North America. So mostly everything that what we sell in North America, it's produced in North America. And then we also have a resilient and very versatile product mix, an asset footprint. So we are having the ability to adapt and bring flexibility to in alignment also in response of the tariffs. And also with pricing, we feel very comfortable and we are in a good place with expecting for the direct impact from tariffs, either none or very, very, very marginal net impact from tariffs to the bottom line. Having said that, we're watching the dynamics very, very carefully. We live in a dynamic world where we see also changes on, particularly in US, on the consumer confidence. Maybe also EAA, North America, the EAA Association has indicated that the gasoline demand would drop from 1% to now flattish, the expectations for the year. We don't see any changes on our customer orders. We have a really good start of the year, a very good Q1, but we're also watching the situation very carefully, and all in that puts us in a good place for reconfirming our guidance. You said that, of both top line, but also bottom line, of 37 to 38 EBITDA margin, and that's including also the negative headwinds from currency.
So can you give us an update on your bioenergy units, and has it changed given the Trump administration view on sustainable energy?
Actually, the opposite. We see extraordinary momentum with our customers. If anything, the administration has already put in E15 waivers for summer earlier. Today, US is using 10% has a mandate of using 10% blending of gasoline-based demand from bioethanol. The market uses more, showing the competitiveness and the strengths of the bioethanol relative to gasoline. And typically in summer, there is a waiver for moving into 15%. And that has already been implemented and put in place earlier, showing also the belief and understanding from the government on the value that bioenergy in. Don't forget that it's not only, yes, it's good for the planet because it drives lower CO2 emissions, but it also drives local jobs, local wealth. And it builds perfectly on security, national security, for decoupling from the need of other sources of energy. You don't need import chips to produce solar panels to make bioethanol. It's based on North America raw materials, and it drives North American local jobs. And that we see that momentum very strongly.
I know you've recently actually announced a deal with your partner DSEB, Finmerish, but after that goes through, will you be ready to spend a little bit more on M&A?
One step after the other. I love that question. We combined two beautiful companies creating Novonesis. That was only a little bit more than a year ago. Then less than a year, we also put the acquisition, as you mentioned, of our fair share of the other part of the alliance from DSM, Firmenich, and bringing enzymes home and creating a stronger channel to market for our animal health and customers in space that we see value and that biosolutions bring in. And we are committed to deliver first the 5 to 8% growth for the year, mainly from volume, mainly from growing with our customers, bringing value solutions for our customers. And of course, we're always going to look at M&A, but that's not our main focus at this moment.
What are the organic growth prospects actually for the business? In particular, how are your clients dealing with low consumer confidence? Is this something that could stay longer term, or is it just a bit of a hiccup for the moment?
We're watching the situation very, very carefully and very, very, very closely. We see the trends on food, on health, on high protein, on clean label, of low sugar added, of no salt added, as strong as ever. This, we don't see any changes in consumer dynamics. We don't see any changes in household care with the solutions that we bring to our customers and the order pattern. It's true that we see changes on the consumer confidence decreasing, only particularly in US, and that's what we're watching very carefully on any potential evolution then, including also in our guidance. We talk about bioenergy in North America, really also solid momentum on bioenergy outside of North America. Growth in Brazil, growth in India, growth in emerging geographies, also from biodiesel, where we see a shift from the chemical processes to the more flexible, resilient, and ductile enzymatic processes, and that's driving also demand. So lots of diversification from a geographical perspective, but also from a mixed perspective. And all of that together, coupled with our global asset footprint, gives us the comfort on the 5 to 8 guidance that we reconfirm.
Esther Bygett, thank you so much for joining us. That was, of course, the president and chief executive of Novonesis. Now, the German chip maker Infineon has cut its outlook, warning of a potential hit from tariffs and currency fluctuations. Revenue for the current quarter will also miss analyst expectations. Well, the chief financial officer, Sven Schneider, spoke to Bloomberg's Guy Johnson a little earlier.
We do not see anything of a tariff impact in our numbers yet, number one. Number two, we do not get any feedback from our customers, which leads to that belief. So that's the baseline. Now, there are two things which we had to deal with and which we have baked into our forecast. The first one is currency. The dollar is much weaker. We had previously guided for 105 euro-dollar. Now it's between 110, 115. Honestly, I don't know where it will be. So we just took 112.5 as a midpoint. That gives us a give or take 400 million revenue headwind in the second half. And then there is the tariff uncertainty. And I repeat and stress the word uncertainty. We believe it's likely that there will be a negative impact on demand in the next quarters, although we do not see it in the numbers yet. And therefore, we have made a guesstimate. It's no calculation because we don't have the data. It's a guesstimate of a potential impact. And we guesstimate that at 10% of our Q4 revenues, which translates, give or take, into 400 million. So if this is coming, yes, then we include that in our guidance, and then the guidance compared to last year is slightly below, indeed.
Well, that was the Infineon chief financial officer, Sven Schneider, speaking to Bloomberg's Guy Johnson. And Maersk has also lowered its forecast for the global transport market in the wake of Donald Trump's trade war. Now, the Danish shipping giant had forecast growth of around 4% for this year, but now says it expects between 1% contraction and growth of 4% at the high end. Now, the chief executive, Vincent Clerc, told Bloomberg that the tariffs have already taken a big chunk out of shipping volumes between China and the U.S.
We've seen drops on volumes from 30 to 40% on these corridors, in both directions, actually, as the trade war really heated up. This seems to have found a plateau today, but I think what is happening is for a lot of those products, there is no easy substitution outside of China or outside of the U.S. So what is really going to be interesting to see is how long can each side actually live on the inventories that they have. How much can they substitute from other origins? And also, how much is their demand for the goods going to be affected? If we see inflation as a result of this, obviously this could have an impact on volumes and could increase the chances of recession in the United States. So those are all risks that we're actually closely monitoring because it will have a big impact on how the second part of the year will look like from a volume perspective.
Well, let's get more on all of that and some of the other big earnings today with Bloomberg's Charlie Wells. Hi, Charlie. What do you have?
Hi, Francine. So it really is this interplay between shipping and defense and kind of how these industries have been navigating the trade war. So Maersk, of course, they had a pretty solid report, but what investors have really focused on is that year forward, given the trade tensions that we're seeing, we know that last year they had solid profit growth, but the estimations for this year ahead are not good, as you can see on the screen behind me. And part of the reason why is that shipping rates are going down. So the amount that it costs to ship a 40-foot container from Shanghai to Rotterdam, so important for European trade, that amount has gone down from a peak last year. Now, some of this has to do with some of the tensions that we've been seeing in the Red Sea. We heard earlier this morning this Maersk CEO talk about how he thinks some of those tensions could continue in the year ahead, and that brings us to defense. A lot of the earnings that we're hearing this morning are from that defense sector. We had a beat from Rheinmetall, and if you just want to step back and take a look, 5 years ago to today, Rheinmetall's share price up 2,300%, more than that. And that just speaks to a lot of the optimism that investors have about these companies, these European defense companies, as European defense picks up. But the question is, can this continue? You see a lot of optimism across the sector. We've got Leonardo reporting later today. They have seen a lot of optimism year to date. But I think the question is, investors know that European defense spending is up. We've seen across the board defense spending up by the most since the Cold War. How much more upside do these companies have as this is already potentially priced into their share prices?
Charlie, thanks so much. Charlie Wells there with the very late on some of the earnings and also what they've done year to date. Now, coming up, we'll look ahead to the Bank of England's interest rate decision due this lunchtime with Vanguard's Tumana Salihian. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
After a pause in March, a Bank of England rate cut is back on the cards at the next decision day. And markets will be listening to Governor Andrew Bailey for clues on the outlook as the UK grapples with the impact of President Trump's tariffs.
We are certainly now in a world of even greater uncertainty.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts today at 12:30 p.m. on Bloomberg. Context changes everything.
The whole theme everybody's been talking about and Powell answered in multiple ways is we don't know and he doesn't know, and it's heightened uncertainty. So you need more balance in your portfolio.
We are almost certainly going to have supply chain disruptions even if we were to resolve this tomorrow, because a lot of ships from China aren't landing here at port, coming to port here. Supply chain disruptions to some degree are almost inevitable.
It's management teams, again, not wanting to overreact, not wanting to have those really tough conversations with their suppliers where they're demanding a discount. Not wanting to have those tough conversations with their customers, trying to push on price.
Yeah.
Because that can burn bridges, and you find out in a month's time, policy changes, and you've made all these changes for no reason.
This has been an extraordinary year, especially given the extent of the uncertainty. They're not pulling back, they're just being cautious, but they're being cautiously optimistic.
Executives there at the Milken conference in LA reacting to the Fed holding rates. Now, the Fed Chair Jay Powell says he will not be rushed into lowering borrowing costs until there's more certainty on the direction of trade policy. Meanwhile, here in the UK, the Bank of England is widely expected to cut rates. Let's get a roundup of the central bank action with Ven Ram from Bloomberg's MLive team. Ven, thank you so much for joining us. As always, on the Fed, I mean, is it the right decision? They basically want to wait and see. It's a little bit maybe too premature to move, given things need to settle on trade and tariffs.
Morning, Francine. So good to be talking to you. Yes, I think that the Fed was the right call from the Fed. I think that they are in no hurry to cut rates. The reason being, if you look at shipments from China to the U.S., they've plummeted in recent weeks, and that lays open the prospect of empty shelves in supermarkets in the U.S. That in turn means higher prices. How much higher? If you look at the break-even rates, Francine, if you look at the one-year break-even rates, they are telling just in September, the markets were pricing 50 basis points. Now they're thinking the inflation over the next 1 year is going to be closer to 3%. That's a humongous jump since the time the market started pricing in a Trump presidency. So all that means that the Fed has to wait. They don't have a choice, which is why I think that there is a bit of mispricing going on. If you look at the overnight index rate swaps, and if you look at Fed fund futures, they're thinking that the Fed is going to be able to cut rates at least 3 times this year. I think that's a bit of a pipe dream. I think we would be lucky if they cut twice.
Okay, so interesting. Then what about the Bank of England? Again, we're expecting a cut, but actually the outlook for the economy has really dramatically changed since last March. Some people think that, Governor Bailey's behind the curve in cutting. Do you agree?
Well, I don't know if he is behind the curve, because if you look at inflation break-evens again, Francine, they were at 4% 1 month ago. They are now at 360. That is way above the Bank of England's inflation target. So there has to be some caution from the Bank of England, which is what Andrew Bailey has rightly been pointing out. I think that, having said that, I think that there is a chance that they are kind of going to be dovish today because of the reasons that Megan Green pointed out in this very program to you, Francine, just weeks ago, that the trade barriers are going to be deflationary for the UK. And for that reason, I think that the Bank of England may think that, may project lower inflation, and therefore that gives them wiggle room to cut rates today. That, of course, is a foregone conclusion. But what happens, whether they will be able to cut rates again in June, is going to be the most pivotal thing coming out of the BOE today.
Yeah, and then, it's just a big day in general, right, for policymakers, because we have Sweden, Norway, and the UK looking at rates. What does it mean for possible opportunities when it comes to bonds? Well, I think that, the terrific sweet spot, in bonds is a German bonds. If you look at their yield, it's not so compelling on first sight. But if you look at the currency-hedged yield on German 10-year bonds, they're offering you a pickup of something like 230 basis points above the nominal yield. So that means you can lock in a 10-year yield of 4.85%. I just put out that research yesterday. It's available on the terminal, and I think it's a fantastic trade for those who are thinking that, where else are you going to get contained inflation as in the Eurozone, plus a central bank that is willing to cut rates again. Therefore, I think that the best opportunity in the bond spectrum at the moment is in bonds. Thank you so much, Van Ram, there, of course, from our markets team, looking at some of the central banks deciding today. Now, in just over 2 hours, the Bank of England expected to cut interest rates by a quarter point. Joining us now, Joanna Salahin, a chief European economist and Europe head of investment strategy group at Vanguard. Joanna, as always, thank you for joining us. It's a big day, actually, to listen to Governor Bailey in terms of how dovish they are, right? Because it is a new reality that we're seeing since they met in March. If we get some kind of trade deal with the U.S., how does that complicate the thinking for the Bank of England?
So I think that the details are yet to be seen, but from what we know now, the trade deal is about tariffs. So the level of tariff, the headline rate is 10%, and there is additional on steel, aluminium, and cars. So can there be carve-outs with respect to that tariff? So big picture, this is good news. But don't forget that tariffs previously, so back in 2024, the average tariff rate for the UK, the number was 2%. And the headline is 10%. So what we're looking at is to bring that 10% down, maybe to something, I don't know, we'll find out the details, but in our base case view, we're thinking something like 7 is where it would settle. So still, the 7 is higher than the 2, but there's a lot of uncertainty out there, and we know that that uncertainty hurts confidence, businesses, and consumers.
Yeah, and it feels like it's hurting. I mean, this was the big question, right, before we actually saw it trickle through the real economy. Does it hit GDP faster and with more force than inflation?
Yes.
Does it change if it's 4%? Does it hit inflation at the margin? But does it boost kind of confidence?
So I think it's, you're absolutely right. Look, it's very hard to know where it's going to show up and how it's going to show up, but we've seen it in the soft data, and the question is when or if that soft data will actually feed into the hard data in the GDP. But that aside, if you look at the UK economy, growth has been pretty weak. If we look back the last 2 quarters, the second half of last year, and the early indicators, January was weak, February a little bit stronger. But I think on the transmission mechanism, I think consumers are also facing that uncertainty, processing that news and saying, what does this actually mean for me, for a company? What does it mean for jobs? What does it mean for investment? And big picture, we have seen that jobs growth slowing. So there's definitely evidence that the economy, both on the growth side and on the job side, is slowing. And inflation, while it's high right now, we expect it to be coming down.
But there's a sticky inflation, right? That kind of, is there, again, you know, I use the words stagflation quite sparingly, but do you worry that we're in a situation where it just gets really tricky for the BOE?
I think it's not as tricky for the BOE as it is for the Fed, right? So the Fed definitely will see those two sides of the mandate pulling in different directions. In Europe, in the UK, it's a very different picture, unless you have reciprocal tariffs. So if we did a reciprocity, that would push up our inflation. But otherwise, you get the global weakness, global uncertainty, which pushes down on global growth, which ultimately brings that inflation down. And even without tariffs, we did see that inflation was coming down, wages are coming down, but absolutely, as you said, sticky.
Jemima, I mean, one of the other things we're trying to figure out is really when you look at the prospects longer term for the Bank of England, where the neutral rate is. I mean, it's really difficult to get actually a member of the MPC to honestly say. I mean, do you have any, is it at 3.5%? Because that also changes the variables of maybe where you expect interest rates to go from now until the end of the year.
Yeah, so you're absolutely right. It's difficult to measure it. There's uncertainty. We do have a measure out there, and we're quite open about neutral rate estimates globally. We think it's 3.5 is what we think. So we do think that the bank will cut rates more this year. So they cut today and cut another 2 times this year, taking the interest rate down to 3.75, which would be close to neutral, and they'll reach neutral next year.
Is there anything else? I mean, what's the one question you'd ask Bailey today? If you know, on the trade or how he sees, we could get a vote that's 8-1 today. How difficult will setting monetary policy be from September onwards?
I think the key question really is thinking about, you know, how are they modeling the trade policy uncertainty? We may see some scenario analysis. We may see how that's being factored in to their forecasts further out. It's obviously incredibly difficult, but that's kind of what I'd be most interested to hear about.
And again, you were talking about this juxtaposition between, you know, the Fed and the BOE. Do you think they look at this divergence? Again, I know they push back a lot and say, you know, we set interest rates for the UK, but you have these opposing forces that might skew them.
Yeah, no, I mean, they have to look at global factors, right? Because we're a small open economy, we will be affected by those global factors. And the key transmission really will be through the currency. So if, you know, the US is on hold, if we're cutting, we see that currency differential. We'll see that interest rate differential be reflected in the currency. And ultimately, you know, if sterling goes up, that's also going to push down on inflation. So there are mechanisms which ties it together.
How dovish do you think the BOE will be today in terms of language? So after the cut, and what does it mean for gilt?
So I think they will try to strike quite a neutral tone. I don't think they'll necessarily, they're not in a position yet to be like signaling that, oh, you know, rates are now moving in this direction, or any kind of forward guidance. With that respect, I think there is still a lot of uncertainty out there with respect to trade policy, and we can't underestimate that. You know, if you look at the numbers in terms of tariffs now, I know we've got the 90-day pause and there are various trade deals, but they're close to 30%. We've not seen those tariff rates since 1900, and we don't know where they're going to go. Our base case view is that they come down towards 20%, but I think that's why none of the policymakers can be dovish or send like clear signals on where things are going while we navigate this uncertainty and get a bit more clarity as to where we're going.
Yeah, very quickly, because I know we're almost out of time, but again, the U.S.-China trade relationship will also have an impact on the UK, and the lower energy price is a huge factor for them as well.
Yes, so that's right. So there'll be an impact through energy prices, but also we know that the headline tariff rates are higher, so there might be cheaper imports from China into UK and Europe.
Jumana, thank you so much for joining us. That's Jumana Salahin, their Chief European Economist at Vanguard. Now, of course, we'll bring you the Bank of England's rate decision just after midday today. For viewers in the UK, we'll also have full coverage of Governor Bailey's news conference in a special broadcast starting at 12:15 p.m. UK time. And then we'll be speaking to the governor. You can catch that interview from 4 p.m. UK time. Up next, Bloomberg Brief.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Trade deal anticipation. Equities get a boost as President Trump teases a major deal with the UK to be announced this morning. A win for chip makers. The Trump administration will rescind Biden-era AI chip curbs after industry opposition. And the Fed stays put on rates, waiting for more clarity. The Bank of England decision up next. So it is that hope of a trade deal that is lifting us for another third consecutive day of gains this morning. We're up nearly 1% for the S&P 500, more coming from the NASDAQ. 10 a.m. is when Trump teased some sort of major trade deal. The reporting suggests that it will be the UK. Also getting some extra juice from a Bloomberg scoop yesterday that some of the Biden-era AI chip curbs will be rescinded. But what does it get replaced with? We're asking those questions later. Buying for now 1.3% is how much higher we are on the NASDAQ. All of that overshadowing a Fed decision yesterday. That stagflation was the clear concern flagged by Chair Powell. Even if he didn't say those exact words, but talking about the tension in the dual mandate. He said some form of weight 22 times, and in fact, the bond market shrugged. Two-year yields had the smallest reaction, the smallest absolute move of a Fed decision day since 2021. That great stat coming from Dan Curtis from our production team. But this morning we move higher on yields, about 4 basis points for your front end. 10-year yields higher by 3.5 at 4.3%. Those are your overall markets. Let's get some stocks to watch. Here with us is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So ARM Holdings, really the big disappointment in terms of the pre-market moves today. We are down around 10%. The UK-based company is actually reporting lower than expected revenue guidance for the quarter. It did list in the New York Stock Exchange, disappointing all of us here. And that stock lower today in pre-market. Then in terms of drug stocks, news from Politico yesterday that Trump is potentially looking at reining in the prices once again, this focusing on the Medicare costs, and we are seeing a drop down in pharma stocks. Eli Lilly, AbbVie, and also Bristol Myers, all down more than 1% this morning. Then finally, AppLovin, the marketing company, offloading its video games company or unit to a UK-listed firm, earning around 400 million cash and a stake in the UK-based company. All of this news and more available, as always, on the Before the Bell opening wrap on the terminal this morning.
Joe, fantastic work as always. We'll catch up with you later in the hour. That is Bloomberg's Joe Easton. Also this hour, in just moments, we'll speak with Lale O'Connor of eToro, and also later, Luis Gonza of Fortuna Mining. Two conversations you do not want to miss. But markets awaiting the details of the U.S.-UK trade deal after President Trump teased the announcement in a Truth Social post, writing that he would hold an Oval Office news conference to discuss, quote, a major trade deal with representatives of a big and respected country. For more, let's get over to Bloomberg's Josh Gallu. So, Josh, is that big and respected country the UK?
It sure looks like it, and the UK sort of basically confirmed that that's the case. So as you said, in a few hours, we're going to hear from President Trump on what that agreement looks like. There's some speculation that it won't be very detailed. So it could just be an agreement to have further negotiations, sort of creating a framework for talks going forward. That is historically, it takes a very long time to negotiate a comprehensive trade agreement that has to be approved by Congress. So it's likely that it's going to be a bit more targeted, certain industries. The UK, of course, got out of the reciprocal tariffs that hit everyone else because it actually has a deficit with the U.S. in goods, but it still is, getting hit by the steel and aluminum tariffs, as well as the tariff on cars. So they have and services. So if the conversation actually moves further into tech and financial services, the UK is wanting to get ahead of that. So we'll see what the details have, but in principle, we're expecting a bit of a framework here for further negotiations.
And it's not just trade deals that are moving markets this morning, Josh. There was also a great scoop from the Bloomberg team yesterday about rescinding Biden-era AI chip curbs. At least this is the plan. This is the comment that we got from the Commerce Department, saying we will be replacing it with a much simpler rule that unleashes American innovation and ensures American AI dominance. Josh, they sure are talking still in a very hawkish way. Do we know what actually might take the place of the current rules and whether it would be a relaxation?
Well, it does look like a relaxation. The AI diffusion rule that came in under Biden was done pretty late in his administration, and it was seen as somewhat of a blunt tool, even by people close to the administration. So, it has 3 tiers of countries, and the idea was to keep AI chips from reaching China, particularly through third-party countries. And that's where the Trump administration appears to be relaxing. Trump will travel to the Middle East in a few days. And of course, Saudi Arabia and United Arab Emirates are planning to invest very heavily in AI in the coming years. And chips from companies like NVIDIA are going to be key. So it looks like what they want to do by revising this rule is to open up the possibility for countries like those in the Middle East that want to make these big investments to make it easier for them to do so.
Josh, thank you so much for your work this morning. We'll also catch up with you later. That is Bloomberg's Josh Gallu. Now, uncertainties abound, especially around trade. And Fed Chair Powell's press conference made it clear that the central bank won't be rushed until there is more clarity.
There's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
Joining us now is Lale O'Connor, Global Market Analyst at eToro. Lale, great to see you. And Chair Powell there acknowledging the elephants in the room. That is uncertainty and the tension to the dual mandate, i.e. stagflation. And the market shrugged. It's a bond market that barely moved. It's an equity market that is now only 8% down from the highs. Is that scenario appropriately priced in?
Yeah, look, I mean, the two things that they said constantly was the fact that it's very uncertain right now, and also the wait-and-see mode that they will continue for some time. I think, again, it was a very balanced view coming from the Fed, and there is no clear price action at the moment, but we do not see a rate cut coming in June. I think it is very likely that they will wait until Q4. All depends on, again, whether soft data will impact hard data and whether this is going to be a persistent inflationary scenario or a lower growth scenario. So it's very uncertain, and the market is, again, not moving right now because it's not known at the moment.
But it does seem to move, Lale, every time we get some sort of trade headline. The most recent one being, as our reporter was discussing, something with the UK. On this point, PIMCO's Dan Ivison gave a really interesting interview to the FT where he said, believe Trump, he believes in tariffs. In other words, markets are underestimating this administration's resolve that there will be off-ramps. Instead, they think it might not look that different from Liberation Day levels. Lale, is that a concern to you that this market is too sanguine about the ability of the administration to reach deals?
Look, we do think that there will be a type of a universal tariff rate. However, we also do not expect a more sort of like reciprocal rate that resembles to the Liberation Day. The reason being that, again, the fiscal space is not there. The bond market is going to punish the administration if they come up with something of a more sort of like a swear scenario. So we would agree with the market in the sense that, you know, it will be a more sort of like a balanced trade policy in place rather than a major sort of like a Liberation Day type of scenario.
Okay, so more balance, does that mean it's risk on, Lale? Are you backing up the truck and loading up then?
Again, be very diversified, we would say. U.S. is still the place to be. Again, there are a lot of high quality liquid companies there, again, cash generating companies. So we are, again, saying that developed markets will outperform emerging markets. Be pro-risk, even in this environment. But again, there are places to hedge your bets again, such as, again, gold. Bonds are a good place to be right now, especially the short end of the curve. A more diversified view, but again, cash is not going to perform very well in this environment.
It is interesting because as we work through the earnings season, some of the commentary we've heard from the tech companies, it's been that their capital expenditures are still happening at a very rapid clip. And then you hear from consumer discretionary companies, or even staples to be fair, that have talked about a waning consumer appetite. Lale, is a picture emerging of one that feels familiar, that is tech as a safe haven?
Look, the recent tech reports are pretty optimistic. They look like they're monetizing the AI capex. Some of them have increased their capex plans as well. So overall, it was optimistic in terms of their guidance as well. But again, we don't know the tariff situation, so we will look for the future quarters to decide whether tech will be a safe place to be. I think, again, you need to be selective. Follow the earnings calls very closely, look at what the CEOs are saying, and again, look at their capital expenditure plans and whether they are monetizing AI. So yeah, just be very vigilant right now.
So off the back of this earnings season, what we have heard, Lale, what sectors do you like?
We like financials. The reason being that, again, any steepening in the curve is going to help margins. We like healthcare. We like industrials as well. So these are the places that we are looking at right now for our investments. Overall, we do like U.S. value as opposed to growth.
Okay, Lale, thank you so much for joining us this morning. Wonderful to see you, Lale O'Connor of eToro. Let's get you some other stories now that are trending on the terminal this morning. Maersk has lowered its forecast for the global transport market, citing macroeconomic and geopolitical uncertainty from President Trump's trade war. The Danish container giant sees the market somewhere between a 1% decline and 4% growth for 2025. CEO Vincent Clerc told Bloomberg that so far, the trade war is mostly a U.S.-China issue. Speaking of China, the country is considering a dramatic overhaul of its housing market. Bloomberg sources saying that China is considering requiring developers to offer only completed properties instead of a pre-sales model. That practice, the one of selling homes before they're completed, has been widely blamed for fueling excess supply and debt buildups. Elsewhere, more than 70 people were arrested after mass protesters occupied the main library at Columbia University. The action was organized by a pro-Palestinian student group. The incident also renewed the attention of the administration. Secretary of State Marco Rubio said that the protesters' visa status are now under review. Coming up, weak forecast coming from chip makers. We're going to look at the earnings results from Infineon and ARM. That's coming up next on your Bloomberg Brief.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Season is here.
Earnings season begins. Is corporate America in a good place?
Wall Street is bracing.
Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings.
We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
Then there is the tariff uncertainty, and I repeat and stress the word uncertainty. We believe it's likely that there will be a negative impact on demand in the next quarters, although we do not see it in the numbers yet. We guesstimate that at 10% of our Q4 revenues, which translates, give or take, into 400 million.
Infineon shares rising even after the chip maker cut its guidance, citing tariff and currency headwinds. For more on the chip sector, we're joined by Bloomberg Intelligence senior tech analyst Robert Lee. Robert, thanks for joining us. Great to see you. And look, this is probably something you don't want to hear from your CEO, that we can only guesstimate the impact of tariff disputes. That's the case for basically every CEO right now. But what do you make of the optimism behind the share price despite a cut to the outlook?
Well, I guess it's a general sort of premise in the stock market. It's all about expectations. So even though the guidance, etc., was a bit less worse than expected, but Infineon is a business that's been under pressure for some time for a number of reasons. Just in brief, you look at the last financial year, their adjusted operating profit declined around 30% year over year, and looking at consensus forecasts for this year, it's going to decline a further 15%. Why is that? Three main reasons. One is the FX pressure that's rising. Stronger euro is obviously a negative or a headwind for their export sales. Secondly, is they're obviously tied to German economic growth and the EV and automotive sector in general. And obviously, given the rising threat from companies in this part of the world, in China, that's an issue for them. And then thirdly, obviously, there's the tariff uncertainty that you've referred to. So Infineon is a fine, upstanding company, but I don't think it's the best barometer on the health of the global semiconductor sector. ARM Holdings, however, I think gives you a much better read.
And should we be worried about that then, Robert? Because the outlook from ARM wasn't exactly rainbows and unicorns.
That's true, but take a step back. We've heard a similar thing from most tech stocks recently. Most companies, given, we've got US tariffs put in one day and then walk back several days later, it's a highly uncertain environment, to state the obvious. So it's incredibly difficult for any companies to budget internally, let alone give external guidance to investors. So I think many companies, not just ARM Holdings, have declined from giving full-year guidance at this point, but just given the very uncertain environment that we exist within. So ARM was previously, well known and seen as a sort of a bit of a canary in the coal mine, because its IP designs go into the vast majority of consumer products globally, or certainly the battery-powered ones. So anything from iPads, smartphones, you name it, ARM's IP is in it. Their guidance for the current quarter fell a little bit below expectations. I wouldn't say that was anything calamitous, but the big thing that's impacting all stocks here is the uncertainty on the second half. I think we've seen a pull forward demand which has benefited the first quarter results. Maybe that will continue into the second quarter, but nobody really knows what the second half is going to look like. And if we see this ongoing uncertainty impacting consumer behavior and consumer confidence, then there's a real risk there. And I think that's why the companies can't give guidance, and I think that's something that the market is increasingly taking on. We just don't know how the rest of this year is going to pan out, and what does it mean for next year? That's an even bigger question. So there's huge uncertainty, and markets hate uncertainty, as I guess every viewer on this channel knows.
That is for certain. Hey, Rob, while we have you, late yesterday we learned that Apple is going to be launching or actively looking at revamping their Safari search to include AI. That's something that hurt Google, but they're also in the middle of this court case over antitrust issues of Google being the default browser for search on Apple devices. How does that fit into the overall picture, this news that they're going to start looking at AI in their searches?
Well, I think maybe just on a personal level, I'm sure obviously everybody's played with the AI chatbots, etc. out there. They're pretty good at summarizing things. They're pretty good at giving you a sort of enhanced search, arguably a better, more useful result than many of the mainstream search engines, with Google being a prime example. So that is a real threat to traditional search engines, not just Google, but companies like Baidu in this part of the world. Whether that is going to cause a sustained upheaval within that search sector remains to be seen. But I think Apple is looking to obviously develop its AI offering. It's highly reliant and in fact licenses in Google's technology at the moment. There's a big question mark as to the medium-term impact on that relationship, particularly if Apple decides to go more in-house on that. So again, more uncertainty, big question mark, and I think that's why you've had the stock price reaction there.
All right, Robert, thank you so much for joining us this morning or afternoon in your time. We appreciate it. Robert Lee, ahead of his long weekend. Okay, coming up, we're going to take a look at what else is making headlines around the world, including President Trump's offer to mediate between India and Pakistan. That's coming up next on Your Brief.
the President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back. And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Welcome back to your Bloomberg Brief. I'm Danny Berger in New York. So we're awaiting a trade announcement that President Trump says will happen at 10 a.m. The reporting has been that will be in the UK. As we wait the contours of it, Sky News has some reporting out just moments ago that the UK has agreed some concessions on food and agriculture to ease the president's tariffs for the car industry. The details, Sky's reporting, are not yet clear. This is less of a tariff issue, more of a regulation issue, as the UK doesn't allow imports of, for example, chlorine-washed chicken and hormone-treated beef. That's common in the U.S., but again, Sky News reporting that some of the concessions that will happen in this trade deal are around food and agriculture. Let's get you some other of the headlines around the world this morning and take a look of what we've got on the front pages. The FT, starting with this about Donald Trump's offer to mediate the spiraling conflict between India and Pakistan. The president said on Wednesday that he hoped the two nuclear powers could stop their worst clash in decades. Stocks in India and particularly Pakistan have traded lower this week as the conflict has escalated. Next up, the New York Times leading with a guidance update from Toyota. The world's biggest automaker sees tariffs erasing $1.3 billion from its profits in just 2 months. Only a year ago, Toyota had reported the highest annual profit by a Japanese firm ever. And finally, the Washington Post has this on their front page, that the U.S. is pushing nations facing tariffs to approve Elon Musk's Starlink. A State Department memo seen by the Post stated that the government of Lesotho had hoped that licensing Starlink showed goodwill as it negotiated a trade deal. All right, as we head to the break, a quick check on your markets this morning. We are headed for more gains after hopes of a UK trade deal coming again 10 a.m. That's when that announcement happens. We are 1% higher. Coming up, we'll talk about that new deal with the UK. President Trump teases a big announcement. Will it be the blueprint of what's to come? That's next.
had a number of games overseas in recent years. And in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Trade deal anticipation. Equities get a boost as President Trump teases a major deal likely to be with the UK announced this morning. A win for chip makers. The Trump administration will rescind Biden-era AI chip curbs after industry opposition. And the Fed stays put on rates, waiting for more certainty. Up next, it's the Bank of England. Some more hints of a trade deal, more gains for this equity market. We are at the highs of the futures session, up more than 1% for your S&P, your NASDAQ up 1.3%. More gains for the NASDAQ, likely because of that Bloomberg scoop yesterday, confirmed by officials that they'll be rescinding the Biden AI chip curbs. What does it get replaced with? All of that overshadowing the Fed yesterday. Staying on hold for a third meeting running, patient tone, flagging in so many words that we might get stagflation, and the market shrugged it off. Let's take a look at the bond market, because the reaction in 2-year yields yesterday was the smallest move after a Fed decision since November 2021. Here's the statistic from Nick Timmeros of the Wall Street Journal that Chair Powell said the word wait in some form 22 times at the press conference. Half of those were referenced in wait and see in regards to what it does with interest rates. But we move higher on yields this morning, up about 4 basis points across the curve. Those are your markets. Let's get some stocks to watch this morning. Back with us is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny, so here's this move lower in ARM Holdings, set to be a rough day for this company. The chip maker missing expectations on its orders for the semiconductors in the latest quarter, and also the guidance looking a little bit weak as well for the UK-based company listed in New York, of course. And we've also got drug makers on our radar. Trump potentially going to be looking to rein in pricing once again on Medicare-funded drugs, and we are seeing weakness across that sector in the pre-market. Eli Lilly, AbbVie, and Bristol Myers all down by more than 1%. Also Moderna slightly lower as well. Then over in mobile apps, AppLovin jumping, the company offloading its video gaming unit to a company based in the UK, in fact, earning around 400 million in cash, and also a stake in that firm, sending that stock up. There we have it, up 14% for AppLovin. Keep an eye on that one in New York later, Danny.
Joe, thank you so much for your excellent work this morning. That is Bloomberg's Joe Easton. Just a quick note coming from Pictet Asset Management, the French asset management giant. They have now downgraded their equity allocation to underweight. They are upgrading cash, saying that we believe this uncertain environment warrants caution. So even with the rally, we do have the bears still out in full force. Now, part of that rally has been expectations for deals, and what could be the first of many upcoming deals. President Trump is expected to unveil a trade agreement with the UK this morning. He teased the announcement on a Truth social post saying he would hold an Oval Office news conference to discuss a major trade deal with representatives of a big and respected country. Bloomberg's Josh Gallo is back with us. Josh, let's be honest, the trade deal we really want to hear about is China, but what sort of blueprint could a UK deal give us in terms of what comes from here?
Yeah, that's an interesting question. We do expect to see some sort of framework coming out of this with the UK, and this is obviously a position that helps Trump's negotiations with the EU as well, where he's. It gives him the ability to sort of drive a wedge there a little bit and show the proximity to the UK and raise the pressure on Europe. That, of course, bleeds over into China and the talks that are coming up this weekend. China came out again and said, the U.S. needs to lift its tariffs. There haven't been a lot of concrete friendly words between the two, so we expect that to remain pretty tense. But with regards to the UK, these trade pacts take a long time to negotiate typically. So it could well be that this is somewhat superficial and either a framework for talks or pertaining to just a couple of sectors that try to show a little bit of progress and some sort of diplomatic solution to the bigger problems that the UK has been having with trade.
Right, and we are getting some reporting from Sky this morning that it seems it will be surrounded around food and agriculture in terms of concessions for the UK. Josh, this is an administration that's extremely busy. We also learned late yesterday that they would be rescinding some of the Biden-era curbs, and the Commerce Department saying this, a spokesperson there, that we will be replacing it with a much simpler rule that unleashes American innovation and ensures American AI dominance. Josh, what might chip curbs look like after this is indeed rescinded?
Well, it seems that the chip curbs are, the main point of the chip curbs was to keep China at bay, because the AI race is really currently between the U.S. and China. And the way that the curbs were structured were to put the steepest penalties on China and then also other countries that might provide the chips to China or the technology. So Trump is about to head to the Mideast, and countries like the United Arab Emirates and Saudi Arabia are planning to just invest tons of money into AI in the coming years. They want access to American technology like semiconductors from NVIDIA, and we expect Trump to be very focused on that relationship with those two countries going forward. And I can imagine out of the new curbs, we're going to see some movement in those tier 2 countries that they belong to.
Josh, thank you so much for your excellent reporting this morning. We appreciate it. Bloomberg's Josh Gallo. Now, as we await that U.S.-UK trade deal, the Bank of England is expected to announce its rate decision in less than 2 hours. Let's get over to Threadneedle Street, where our UK correspondent Lizzie Burton joins us now from outside the BOE. Lizzie, what are we expecting this morning?
Well, in terms of the conversation we were just having, we've been asking ourselves, Danny, whether this UK-US trade pact even moves the needle for the BOE. It certainly thrown a spanner in the works for Andrew Bailey at the press conference. But the answer is it probably doesn't, because, look, they already voted on today's decision before this Truth Social post came out. And beyond that, it doesn't really change the outlook for the UK economy, according to most economists. Excuse the police car just go past that I've been speaking to this morning, because, look, the global outlook remains one of elevated uncertainty and depressed demand. As you said, Danny, the focus really is on whether we get a US-China trade deal. And until you do, you're still likely to see the UK market flooded with cheap goods from China, which is, of course, disinflationary. And when you've got that depressed demand, you've got lower oil prices, again, disinflationary. So the argument that we are expecting the BOE to make today, that tariffs mean lower growth and lower inflation in the UK, seems to still stand.
Lizzie, there feels to be something extremely symbolic of you talking about the UK economy as literal sirens are going off in the background behind you. But on this point that you're talking about, like we heard it from the Fed yesterday, this uncertainty, you're mentioning it too. So just how dovish can the BOE be at this point, given the lack of clarity on how things actually will look in even a week's time from now?
Yeah, look, Danny, I'm expecting to be playing uncertainty bingo at this press conference from the BOE later. The dovish twist could come in two forms. Now, it could be the vote split. We've surveyed economists, and 20 out of 32 of them reckon that one member of the Monetary Policy Committee at least, is going to vote for a jumbo cut. And it'd be interesting if that isn't just the Archdove Swati Dhingra, but maybe the Deputy Governor Dave Ramsden. He's got form pivoting the committee. Maybe it's Alan Taylor, the newest member of the Monetary Policy Committee. And yes, the Governor Andrew Bailey has said to us the vote split isn't some sort of communication device, but I am sure the market will take it as one if you see more than one member going for a jumbo cut. Then you've got the guidance, and at the moment they're describing the rate path ahead as gradual and careful. Careful because they wanted to take account of Trump's tariff policy. If they drop that, maybe it suggests that the balance of risks is skewed towards a slowdown in growth rather than a rise in inflation. And if they drop the word gradual, that opens the door potentially to a June cut. And Danny, that would be the first back-to-back cut from the Bank of England since COVID, and before that, the global financial crisis. So the tone today from the Bank of England could be way more dovish than we got from the Federal Reserve last night.
Lizzie, really looking forward to your coverage when that decision comes in about 1.5 hours' time. Lizzie Burden. And just a programming note, the decision will happen at 7:02 a.m. Eastern Time, that 2-minute pause for a VE Day reflection. Okay, let's get to some other top stories that are trending on the terminal this morning. Maersk has lowered its forecast for the global transport market, citing macroeconomic and geopolitical uncertainty from President Trump's trade war. The Danish container giant sees the market somewhere between a 1% decline and 4% growth for 2025. CEO Vincent Clerc told Bloomberg that so far the trade war is mostly a U.S.-China issue. Speaking of China, it is considering a dramatic overhaul of its housing market. Bloomberg sources say that China is considering acquiring developers to offer only completed properties instead of a pre-sales model. That practice, the one of selling homes before they're completed, has been widely blamed for fueling excess supply and debt buildups. More than 70 people were arrested after mass protesters occupied the main library at Columbia University. The action was organized by a pro-Palestinian student group. The incident also renewed the attention of the administration. Secretary of State Marco Rubio said that the protesters' visa status are under review. Coming up, we turn back to the state of these markets and gold specifically. Fortuna Mining CFO Luis Ganoza will be joining us to discuss impacts to the mining industry. That's coming up next on Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Now, the uncertainty surrounding a global trade war has driven a surge in gold prices this year. Let's get to this month's CFO briefing. And as always, we're joined by the wonderful Nina Trentman, the editor of the CFO Briefing newsletter. Nina, great to see you this morning.
Thank you for having me.
And we're focusing on Fortuna Mining, reporting sales for the first quarter that met the street's expectations and delivered a new record quarter of free cash flow. Fortuna Mining is headquartered in Vancouver, operates mines in Argentina, Mexico, and Peru, among many other countries. I'm pleased to say that the CFO, Luis Ganoza, joins us now. Luis, thank you so much for seeing us this morning and stopping by.
Glad to be here. Thank you.
So just how big of a boost are you getting from gold prices that are just seeing record after record?
Yes, absolutely. We reported, as you mentioned, a record free cash flow for Q1 2025, $111 million, over $290 million of sales. That's free cash flow, I should say, before new developments and growth initiatives. And that's 38% margin, right? Quite significant. We reported 20 cents per share, which again is a record for us. And if you think in terms of what we would expect for the year, considering Q1 metal prices, that's still free cash flow given the timing of other operating items like tax payments. That's still going to be 30% margin over sales, so quite significant.
Where do you see gold prices going from here, if you want to make
yes,
a guess?
Well, that's the big question, of course, right? We all are quite aware that the world as it is today is quite conducive to the type of metal prices we're seeing, the trends we've been seeing in geopolitical uncertainty, economic, political risk all over the world. But the way we see things, where things go from here falls more in the realm of the unknowable, right? And we really focused on what we can control, which is cost. This business is all about cost containment and setting yourself up to operate as much as possible within the average of the cost curve for the industry, right? So that's our aspiration. That allows you to still generate decent profits during the down part of the cycle, and of course harvest in times like this.
You recently sold 2 assets in Burkina Faso and also in Mexico. I'm wondering how you're thinking about potential deal making. Like, are you on the lookout for potential targets?
Yes, absolutely. So that's 2 mines that in principle we will seek to be replacing. A big tool for that for us is M&A. And we currently operate in 2 important gold-producing regions in the world, LATAM and West Africa. And that really expands the universe of business opportunities for us, right? In this business, most companies will be focused in one region of the world. Some of our peers, right, advertise themselves as one business, one country, one metal. So for us, it's quite different. We've been in West Africa for over 3 years now. We feel very comfortable there, and West Africa is one of the fastest growing gold producing regions in the world. So that creates a wide range of opportunities, and we're quite active today seeking new ways to deploy capital.
Luis, in that answer itself, you mentioned just the huge breadth of countries that you operate in. You're, of course, headquartered in Canada as well. We're in this moment. We're driven by the U.S. The trade lines are being rewritten. Relationships between different countries are being rewritten. The way capital flows is getting another look at. Has it changed for you as a global business operator?
So the answer is twofold. One is we really don't see ourselves as a global operator. We are a relatively small company in the big scheme of things, right? So our focus is on two regions, LATAM, which is a historic mining region, and West Africa, right, which is a relatively contained region within Africa as a whole. So you will not see us hunting for projects really all over the world. That's one. That has important benefits. It allows to leverage on your knowledge and expertise of the regions in which you operate, right? So that makes a lot of sense for us. And with respect to the question of tariffs, we don't see any impact today for us in the business, right? Any direct impact is something we're monitoring, but so far, I mean, there's nothing to report.
How are you monitoring that? Obviously, it impacts the gold prices. We've heard from other companies that have done things like assembled task forces specifically to look at this. Is that something you're doing?
We are in that process. I think we've done through an initial scan of what are the main elements of our supply chain that could potentially get impacted. And I mean, on a first company-wide exercise, we really haven't seen anything of significance that is worth reporting or being concerned about, right? But as things change, things are being very dynamic. That's something we'll be continue to focus on, right?
You also operate in Argentina. I'm curious to see how you're viewing the business environment there after 16 months about that time with Javier Milei making a lot of changes in the country.
Yes, absolutely. So in Argentina, for an exporter like us, it's really all been about the peso appreciation over 2024. And the ability to repatriate funds, right? Now, beyond that, we all want Argentina to do well. And the first phase of Mr. Milei's program in terms of inflation containment has been successful. I think that's widely accepted. And the key thing comes, the key next phase comes this year as Argentina needs to restart growth for this to be sustainable. It needs to start accumulating foreign currency reserves. So that's what we're watching for this year. And ultimately, the removal of the capital controls will be a function of that, in our view, right?
Just curious in terms of buyback spending and shareholder returns. I think you recently renewed your share repurchase program. Like, talk a little bit about that.
Yes, we have an NCIB out there. We were very active in Q4 of last year, where we saw opportunities in the market, and that again will also be a function of conditions in the market and potential alternative uses of funds, right? We are in a transition phase. As I mentioned, we need to replace potentially 2 assets. We do have plenty of liquidity today. So return to shareholders is an important element of our strategy. As far as repurchasing shares in the market, it will be very much a function of what makes sense at a given time, right?
Hey, Luis, before we let you go, one of the oddities of what gold has done is the premium of it in the U.S. And you had these crazy stories about filling planes up with gold, trying to get them over to the region. Other commodities also coming from South America, ships absolutely stacked with the various commodities. I wonder how much you keep track of that and whether those weird sort of tensions are still present in the global shipping and airline industry.
Honestly, not really. A lot of weird things start happening when gold hits $3,000, right? Yeah, and as I mentioned, for us, we're projecting a great year. I mean, there is uncertainty in the gold price always. It's volatile, but in the short term, we do have the sense that things are going to.
If I can jump in, does that uncertainty sometimes cap how much you're willing to spend on capital expenditures? Because obviously you have new projects you're eyeing and that sort of thing.
Yes, absolutely. For us in particular, when we think of gold price and new investments, our view is very conservative. When we look at deploying capital or assessing a new project investment, we are looking for an asset that can yield 20% plus returns over the life of mine at $2,000, right? So it's not the time in our view to start using $3,000 or even $2,500 per ounce to think of returns over the next 8-10 years, right?
Luis, thank you so much for joining us this morning. We really appreciate your time. That is the Fortuna Mining CFO, Luis Ganoza. Nina, thank you as well. Please check out her newsletter. That is Bloomberg's Nina Trentman, the CFO News Briefing. And you can find more, again, with her interview with Fortuna Mining. You want to subscribe to that at bloomberg.com/newsletters. All right, some breaking news to bring you. President Trump has confirmed, it would appear, that the deal we're going to get will be from the UK today. In a Truth Social post, just writing, today will be a very big, exciting day for US UK. Again, the assumption is that 10 a.m. when he makes the announcement, it will be with the UK. Now, as we had to break, just some pictures for you from the Vatican. Black smoke is coming out. I don't know if you can see it in those pictures. It was there. There you go, just a moment ago. So no new pope for you yet as the conclave continues. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Let's get you set up for your trading day on this Thursday. The BOE will be announcing its rate decision at 7:02 a.m. Eastern, just shortly after a 2-minute pause, a moment of silence for Victory Day, Europe Day. Then another round of U.S. jobless claims that comes at 8:30 a.m. And tech executives will be speaking before a Senate panel at 10 a.m. That includes Sam Altman of OpenAI and Lisa Su of AMD, among others. All right, that is it for your Bloomberg Brief. Things to keep an eye out. 10 a.m. We will hear from the president about a big deal in a Truth Social post, just saying it will be a big day for the UK. So balance up next.
literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Today, the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen.
The Fed is not really sure where tariffs are going to land, and when they land, they're not really sure what the consequences are going to be.
Uncertainty has clearly risen. The pain threshold for the Fed is going to be elevated.
We're getting slowing growth in the second half of the year. The question is, what will they do about it?
We're under known unknowns and unknown unknowns. The probability on both bad outcomes has gone up.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday as Chair Powell is going nowhere fast.
We don't think we need to be in a hurry. We think we can be patient. We're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low.
Chairman Powell snapping into wait-and-see mode, waiting to see the outcome of trade talks, waiting to see if the economy breaks. As the U.S. and China heads towards the weekend, preparing to negotiate, the president teasing a, quote, major trade announcement with the U.K. for later this morning.
Yeah, so do we start getting deals? And it's going to be important to understand what the contours of those types of deals might be in terms of, does that 10% threshold get dropped when it comes to some of our closest trading partners? I just want to say, how do we continue after Jay Powell said wait and see 12 times and wait by itself another 13 times? Really, I mean, this is basically, and Blake Gwynn said it perfectly over at RBC, it was the epitome of this could have been an email with just a subject line that said wait and see.
He's got to wait and see the outcome of these talks. Wait and see for 10 a.m. Eastern time when we hear from the President of the United States. Wait and see the content of this so-called trade agreement. Now, I've heard a lot of people say this could be a template for other nations. I want to be very clear about this. This could be the best case. You've got a relationship between two countries that's pretty good, the US and UK. You've got a trade balance that's pretty balanced between the US and UK. And if they are negotiable, the 10% baseline tariff, I would see whatever number they come up with, if they do indeed adjust that number, and that is still an if, I'd see that as a new floor for tariffs. I wouldn't see that as the baseline for everybody else.
That's the reason why people are watching this so closely. It's sort of a question of, can we go below that 10%? Because the UK is the one friendly partner that only had that 10% ceiling, or floor rather, that was imposed upon them. Here's the key question. What are the ultimate goals? How quickly can they move? Is this going to be a contour of some sort of deal? And then what are the negotiating guidelines? Do we get any sense of what that is from this particular negotiation, given that it was most friendly from the start?
report.
The S&P 500 high this morning. Equity futures up. The S&P higher by 1 full percentage point. Coming up this hour, we'll catch up with Stuart Kaiser of Citi, with the president set to announce a trade deal. Claudia Saab of New Century Advisors on what she calls the Fed's missed opportunity. And Kelsey Barrow of JP Morgan Asset Management with Chair Powell in wait-and-see mode. We begin this hour with stocks rising as President Donald Trump teases a major trade deal. Stuart Kaiser of Citi writing, equity markets will look for concrete results at this point, with focus gradually shifting to the ultimate level of tariffs. Stu joins us now for more. Stu, good morning.
Good morning. How are you?
Good to see you. For how much longer can the promise of trade deal sustain this equity market rally?
I mean, I've actually been surprised at how well it's gone, to date. I think you both, use the right terms: contours, frameworks, boilerplates. I think that's what the market's looking for right now. And that our view is you take your key trading partners, your allies. If you get a deal with one or two of them, the market's going to extrapolate that out to this is what a trade deal looks like with a key trading ally. And then you have to deal with China, I think, as a second step. I think the news has probably been a little bit slower than you would have hoped with the allies, but probably a little better, at least in the rumor/headline side, than you would have hoped with China. So, yeah, at this point, rubber needs to meet the road. We need to actually see some numbers here because, as I think Chair Powell said, you're in a wait and see. But while you're in that wait and see, you have a tremendous uncertainty shock that's hit the economy. So the longer you wait, the worse thing you're going to see at the end of it. And I think that's how the market's dealing with it.
The risk is we go into an air pocket for the hard data. HSBC this morning pushing back, saying fundamentals remain dire. Negative activity surprises could see risky assets fall quickly. We also remain doubtful that a policy move from the Fed alone, a so-called Fed put, would turn market sentiment around. What's the Fed's place in all this?
I think it probably goes back to what our playbook has been in the past, that if the Fed is cutting to get you out of a tariff crisis, so to speak, then the markets are going to be meaningfully lower by the time they cut, right? So I think, the markets, I think for now are in this holding pattern, trading at a pretty kind of wide range, and they're looking for resolution. They're looking for evidence of how this is ultimately going to play out. But, our view a month ago was you need these trade deals done pretty quickly, because if not, the uncertainty shock hits the economy, and as Chair Powell detailed, the risks in both directions are actually higher than they have been in a while.
I think it's fascinating that at 10 a.m. Eastern, we're going to get this trade discussion or trade announcement potentially with the U.S. and U.K. At 7:02 a.m. New York time, we're going to get an announcement from the Bank of England, and they're expected to cut rates by 25 basis points in response to weakness, in part because of the trade war. It just raises this question: why is that viewed as such a disinflationary shock around the world and not viewed the same way in the United States?
I mean, part of it's, we're the biggest economy, and I think they're hoping that that'll get us out of it. I think second, frankly, is just the data, right? I mean, so far, and part of it's just timing. The employment data, the inflation data actually looks pretty good. The Fed is trying to message something that's fairly friendly. And look at corporate America. 2/3 of companies that reported this earnings season have left guidance in place. So corporate America is also in a wait-and-see mode. I'm not sure that people are, assuming the outcome will be better in the U.S. at this point. I just think they don't know, and it's just sort of a delaying tactic at this point.
From an equity perspective, are people underestimating how much certain companies will benefit from the current regime? And I'm thinking of the likes of Carvana, which came out and actually upgraded its forecast and delivered better than expected earnings. Because guess what? Used car prices have gone up, and they've actually delivered a much higher level of sales. At what point do you feel more positive just because people seem to be discounting some of those tailwinds?
I think it's a great point. Everybody's been focused on the negative. I think the area where we've been most positive, frankly, is growth stocks, those large cap tech stocks that are a little bit less impacted by tariffs and had this massive PE derating. So I think, the trouble coming into this was the companies that might benefit or the more defensive stocks were so expensive that it was kind of hard to own them ahead of all these tariff headlines. They're not as expensive as they were. So I think what you're seeing is people are re-engaging on stocks that are a little less impacted by tariffs. And secondly, the stocks that have just derated so much that a lot of that bad news is frankly already kind of discounted in the price. The problem is the largest market cap stocks are probably not the tariff beneficiaries, which kind of puts you in a really tricky spot from a portfolio allocation perspective.
Are you saying we can play defense with big tech?
Yeah, we are. Big tech / just growth stocks in general, we think are defensive. Now, the long leg of growth, so to speak, had a 25% PE derating late February into early March. And once you took the positioning and valuation risk out of those stocks, what you're left with is stocks that generate a tremendous amount of free cash flow, have awesome balance sheets, are generating a lot of earnings growth. So we do think growth is defensive again after that PE derating. And frankly, we've seen clients engaging quite a bit to the long side in large cap tech.
Yesterday afternoon was fascinating for all of us sitting around the table. One headline suggesting that tariffs weren't going down. Another headline suggesting that the equity market whipsawed. And I saw one person question whether this equity market was investable right now. And I think it's always investable at a price. And it's the superior American multiple that I want to understand from you whether it's in question right now, given how whipsawed we are, not by fundamentals, just by headline to headline and a ton of policy volatility.
Yeah, I think investable, I think there's probably two things that go into that. One is the relative valuation, and two, what's your holding period? You know, I think if you're a long-only, long-term holder, and you can engage in these stocks 25% below what you were paying for them in February, and you have a lot of confidence in their fundamental outlook, that part's investable. A lot of the clients we talk to that are trading day to day and week to week, it probably doesn't feel nearly as investable. You know, the PE premium, it's a good question. I mean, the reason the U.S. trades at a premium is because we generate a much, much higher return on equity, basically, than any other market in the world. So to the extent that that relative ROE gap remains in place, then frankly, we should, you know, trade at a bit of a premium. Go back to Walmart earnings, for instance. They specifically kind of called out that we're keeping our numbers in place because we think our price advantage persists even in a post-tariff world. So point being, the tariffs are an issue for valuation, but on a relative basis, is the U.S. sort of still better positioned to deal with that? And frankly, I think the White House believes that. They believe that we're the largest economy in the world and we're a net importer, so we're ultimately going to be better off through this. Again, that's their view, not a City House view, but you know, that's what the market's trying to discount, to your point.
Do you think it's overly dramatic to point to the fact that people are not seeing the same benefit in investing in dollar-denominated assets, risk or otherwise, as a hedge because the dollar tends to rise in times of dislocation? Does that type of technical dynamic seem like it's maybe a little exaggerated to you, or do you think there is something legitimate there?
Look, I think some investors are looking at this as a complete regime change in how kind of global markets work, right? So the attractiveness of the dollar as a defensive haven is sort of under pressure because of tariff policy. So I do think that's meaningful, and I think that's why you're seeing gold perform so well, right? You buy gold, you're short the dollar, but you're not long any other currencies. And I think people have wrestled with this idea. Okay, if the dollar isn't the safe haven, what other currency do I want to own when I have all this tariff uncertainty? And I think a lot of investors are voting with their feet and saying, I don't want to own any of those other currencies. I'm just going to buy gold. So I'm sort of long gold, short dollar. So look, I think it's a reasonable question. I think we don't know how it's going to play out in any way, shape, or form. And that's the uncertainty premium that's in the market right now. And again, it's benefited gold without question.
You know, John started the show with a theme that will continue to be the theme for a very long time, which is how much more does this market need around the tariffs to really get a sense of what the new framework is and to get a real sustainable rally rather than this sort of choppiness. What are you looking for to give you a sense, okay, this is something to buy rather than something to maybe trade if you're an algo, but otherwise just stay back and hope that it'll pass soon?
Look, honestly, I think it's just a lot more clarity. I'm actually kind of a little disappointed corporate America punted and said, oh, you know, 2/3 of them just left guidance in place, because what that means is 3 months from now, we're going to be asking the exact same questions, right? So I think, you know, we definitely like, I think, corporate America to tighten up, you know, what their view is on tariffs, without a doubt. I think that'd be impactful. And then, again, what you guys, you know, detailed at the beginning is, we need a boilerplate that can be applied to a wide range of countries, ex-China, so that we can really get a sense of how this is going to impact growth. And frankly, that's been our view for a month, is you need deals with these key trading partners to get there. So I think it's I hate to say it's certainty, but more so it's give us some numbers so corporate America can put those numbers in their models so they can update their guidance, so that now we have a really honest view of what the risk reward on earnings looks like. And I think at that point, you can pick a point, a valuation level that you can engage with the market in.
We want the rules of the game. And maybe it starts this morning. This from the president this morning. He's hitting the ground running already on Truth Social. Here's another post for you. The agreement with the UK is a full and comprehensive one that will cement the relationship between the United States and the UK for many years to come. Because of our long history and allegiance together, it's a great honour to have the United Kingdom as our first announcement. Many other deals which are in serious stages of negotiation to follow.
What it highlights to me is the desire, even from this White House, to move more quickly and to give those contours in a way that also sets the stage for the U.S. to potentially say to other trading partners, okay, you want to make a deal with us, come to us, and then we'll treat you well. So this is actually one to watch, even though it's the less contentious one. It's the one that might be really important to give you exactly what Stuart was talking about, those contours.
That's the hope of the equity market this morning. Jim Karen and Morgan Stanley writing in. Jim, good morning. The significance of a deal with the UK extends beyond the UK itself. Does this trigger a series of other deals to follow? Once the first domino falls, the rest are soon to follow. that's the hope, I think we do have to caution this is a unique relationship with the UK, a trade balance that is fairly balanced at the moment. How much difficult will it be for those other dominoes to fall from here?
And when there are a lot of other issues, you're talking about the VAT tax, you're talking about other potential gripes around technology when you're talking about Europe, and of course China is its own ball of wax. So there's this real question here of how much you can actually depend on this as providing that framework, that rubric, that concept.
Stu, just to finish with you, on this note, just for now, how much easier will it be once the first domino falls? Or do you still see a lot of sticking points with some major trade partners?
I mean, it'll be positive for risk, but I think what Lisa mentioned is very important, which is non-tariff trade barriers, which are really, really hard to negotiate, right? It's very hard to negotiate, employment or labor law. It's very hard to, negotiate something like a VAT tax. So it is going to be positive because the market will extrapolate it. But, to your point, this is a unique case. I think they're all unique cases with their unique moving parts. So the market will probably, react very positively to this news and then probably take a step back when they, have to deal with all those issues.
Stuart Kaiser City is going to sit with us for another 15 minutes or so. Equity markets right now, session highs by a little more than 1% on the S&P 500. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief. President Trump will make a trade announcement this morning. He posted on Truth Social. This should be a very big and exciting day for the United States of America and the United Kingdom. Press conference at the Oval Office, 10 a.m. Eastern Time. The wait for the next pope will continue after black smoke poured out of the Sistine Chapel chimney once again. Cardinals failed to reach an agreement after 2 new rounds of voting. 2 more rounds will happen later this afternoon. And finally, ARM Holdings shares falling in the pre-market after the chip design company gave a disappointing sales forecast for the current quarter, fueling fears of a tariff-driven slowdown for the industry. ARM also said it would not provide an annual target due to uncertainty. And that right there is your Bloomberg Brief. Up next on the program, a so-called major trade deal.
We're going to put very fair numbers down, and we're going to say, here's what this country, what we want, and congratulations, we have a deal. And they'll either say, great, and they'll start shopping, or they'll say, not good.
Up next on the program, we'll catch up with Bloomberg's Anne-Marie Hordern down in Washington, D.C., and you'll hear more from Stu. From New York City, good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures near session highs on the S&P 500, up by 1 full percentage point on the S&P as we look out for the details of a major trade agreement between the US and the UK. Under surveillance this morning, a so-called major trade deal.
we will sign some deals. But much bigger than that is we're going to put down the price that people are going to have to pay to shop in the United States. Think of us as a super luxury store. We're going to put very fair numbers down, and we're going to say, here's what this country, what we want, and congratulations, we have a deal. And they'll either say, great, and they'll start shopping, or they'll say, not good.
It's the latest this morning. The president will announce a trade agreement with the UK at 10 a.m. Eastern time. The president teasing the announcement on Truth Social, calling it major and saying it's the first of many. Joining us now from Washington, Bloomberg's Anne-Marie. AMH, let's get to the details. Have we got any idea of the substance of this agreement?
Well, this is just an agreement. Remember, trade deals take months or years. So memorandum of understanding, that's almost what this is going to be like, even though they want to call this a deal. Here is the details that you need to look out for. What the United Kingdom wants to see from the United States is a cut of tariff quotas on things like steel and the car industry. That is incredibly important for the Prime Minister, Keir Starmer. What the U.S. would like to see the UK have is a lower tariff rate on U.S. cars going into the United Kingdom, and also potentially we can see a cut to the digital services tax, which we all know has been a thorn in the side of UK tech companies for years. So those are the two big parameters I would be looking for going into this 10 a.m. press conference with the president. But we should really caution. This is going to be an outline, a blueprint of potentially a more comprehensive agreement down the road.
Anne-Marie, how much is this really a template for other agreements with other types of trading partners versus kind of an anomaly given the special relationship that the UK and the US have?
Well, I would say two things on this. One is that there is this special relationship. And you remember in early March when the Prime Minister came to the White House, he came with that what he called unprecedented second visit invitation, a state visit from King Charles. He touched President Trump on the shoulder and said, this is unprecedented, this is very special. And we have seen the Prime Minister really try to fortify a warm relationship with the United States. Remember, the UK has been trying to get this deal done since Brexit in 2016. The second thing I would say for the United States, it is important because of Europe. They are trying to potentially make it harder, put some pressure on Brussels. So what do? You go out, you get an agreement with its neighbor to the north, the United Kingdom. And also, the Treasury Secretary Scott Bessent is traveling to Switzerland. And we're all talking about the fact that he's going there to meet with his Chinese counterparts. But he's also going to be meeting with the president of Switzerland. So right now, what you see the United States doing is getting two countries in Europe to potentially get over the finish line in some sort of trade work agreement without Brussels on board just yet.
Anne-Marie, appreciate the update. More from Anne-Marie later on this morning. I think this is part of the criticism on Chairman Powell yesterday in the news conference, that he chose to emphasize the risk of the worst-case scenario, higher inflation, higher unemployment, lower growth. And we said in the news conference just after it that there is a best-case scenario here, that maybe the tariffs come down, maybe the deals start to flow, maybe the economy improves. And the chairman didn't really entertain that in any way, shape or form through much of that news conference.
Yeah, Mohamed El-Erian has been talking about maybe a 50-50, 60-40, then 70-30 kind of chance that it could be, yeah, it could be bad, but it could also be really good. And how does that change their viewpoint? Is that inflationary? Is that disinflationary? Is this putting them back on that soft landing scenario? If they're going to give a sense of what their response function is, scenario analysis is going to be key. And they stepped away from that and said, absolutely, we are not going to say anything, and we are successfully going to filibuster this entire meeting.
It drives me nuts. Politicians do it too. We won't engage in hypotheticals.
Right.
Okay, if you're presented with that by a central banker, this is the follow-up. Can everyone just follow? If they say we won't engage in hypotheticals, the follow-up question is, how do you communicate your reaction function without engaging in hypotheticals? You can't. And your job as a central bank is to explain your reaction function. I don't want your forecast. I don't really care. I can lean on Stu and Andrew Honhorst for forecasts. I don't need that from the Fed. I want to understand how they respond to incoming information. And yesterday, sorry for being a little bit harsh, yesterday, I think they did a pretty lousy job of explaining how they'd respond to incoming information.
Yeah, I mean, I think another question could be, what would make you hike rates? Is there anything out there that would make you hike rates? Because potentially there could be inflation with growth. And oh, by the way, can't you see yourself in a scenario where tariffs go down and suddenly it's this sort of soft landing nirvana that we'd all been talking about? How do you game that out and understand what data to look at and how much? Instead, they said, you know, we look at models, we look at data, we put them together, we take them apart, we put them in a box, we take them out of a box, we're still talking. That was sort of how it felt.
Governor Waller was clear-eyed a few weeks ago. He's like, if the labour market gets bad, we're cutting interest rates.
Right.
And maybe quickly.
Yeah, well, I mean, in fairness, and this is in fairness, there is the challenge of if inflation is high, and has been high for this type of time, do they have to wait longer in order to allow the economy to break so that inflation does come down so it doesn't turn into a 70s type of scenario? That is the worst case scenario, and that is clearly the shadow that seems to be hanging over this Fed.
Jobless claims later this morning, 231 the previous number, 241. 230 is the estimate this morning. Stu, I want to bring you in. How would we react to a higher jobless claims number if at the same time you're getting trade deals? Do you ignore the weakness, or do you start to worry that a process has started?
At this point, I think the trade deals probably outweigh, the economic data, like tactically in that way, because I think what the market will say is, well, yeah, we got a little rise in claims, but if these deals get resolved, then anything on a growth perspective for the market would kind of be a transitory growth slowdown, and we'd respond to that. So, I mean, right now, tariffs are kind of driving the bus, and I think for the Fed, growth is more important than inflation right now. So you're kind of like balancing these two things.
You're convinced they can respond to a turn down in growth?
Well, I just think if they have to rank their priorities right now, I think growth is the higher priority. They can respond. Can they respond enough to overcome a massive global trade war? I think that remains to be seen. But to your point, most investors are looking at the market through risk-adjusted returns and probabilistic outcomes. So if the Fed is not offering you any additional information on the probabilities of these outcomes, I mean, they can lay out 3 outcomes, but then you have to assign probabilities to each of those, right? So it's a multi-layered thing, and I think the Fed does not want to get caught in that mousetrap. So they've just decided to kind of stay away from all of it.
There are some questions with some tangible answers, which is how much pain has already been done, how much companies already have to bring down some of their estimates for profitability as well as sales, and have ships that might not be coming from overseas. Do you think that that is enough for the Fed to have seemed more concerned about a weakening in growth, or do you think that that also has been overplayed because of the upsides in a number of companies as well?
I mean, I think they're paying attention. They talk to corporate America, but as I mentioned, 2/3 of companies have kept, guidance where it was. About 16% have cut that guidance. Those stocks have gotten sold off when they've cut guidance. I think the Fed will be very aware of that. But I think corporate America and the Fed are both in wait and see mode at this point, and they're sort of in largely in agreement on it. And frankly, look, we haven't seen a huge uptick in claims. We haven't seen a massive rise in the unemployment rate. We haven't seen a particularly big move in inflation. This is a soft data issue right now, so it's sentiment. And I think Chair Powell yesterday tried to say there's a somewhat loose relationship between that soft data actually translating through to a slowdown in hard data, and that's why I think they're being conservative. The fact is, you could turn survey data like that, right? I mean, if you get these trade deals, survey data is going to immediately, shift higher, which is why I think they don't want to, step in front of that bus right now. They just want to let that bus go by and figure it out, just because, the survey data, A, is with a lag on hard data, B, with sort of a somewhat questionable relationship, and C, it could be different 2 weeks from now if you get a lot of trade deals.
Stuart Kaiser at Citi. Stu, good to see you.
Thank you.
As always, thank you, sir. We're all in wait and see mode, waiting to see what happens at 10 a.m. Eastern Time. The tease came from the President a little bit earlier this morning. The agreement with the UK is a full and comprehensive one that will cement the relationship between the United States and the United Kingdom for many years to come.
And the reason why this is so important to market participants is potentially it is the first such framework that can give a sense of what future deals could look like, as well as what approach this White House takes to these negotiations.
Up next on the program, we'll catch up with Claudia Sam of New Century Advisors on the Fed's wait-and-see approach. Equity futures on the S&P positive by 1 full percentage point. Live from New York, this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah. We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The prospect of a full, comprehensive trade agreement between the United States and the UK to be announced at 10 a.m. Eastern Time, the details of which could move this market one way or the other. The hope is that this is the start. The dominoes fall from here in a positive way and more deals come. Equity futures at the moment positive by 1 full percentage point on the S&P. On the NASDAQ, up by 1.4. On the Russell, up by 1.5. With 3 hours until the cash open. With your morning movers, it's Danny Berger. Hey, Danny.
Hey, John. The other piece of news coming out of the White House that lifted chip makers specifically yesterday and continues to today is that the Trump administration plans to rescind Biden-era AI chip restrictions. It's going to replace it with something. We don't know what that something is yet, but the optimism continues. NVIDIA immediately turned around yesterday and jumped 3%. It is still up another 1.8% this morning. Not all chip makers are created equally. ARM reporting earnings. The chip designer out of the UK, shares falling nearly 9%. It gave a disappointing forecast for this current quarter. Now, it just blamed the timing of contracts with new customers, but this is a market just given by the sell-off that believes it might be more pernicious than that it might have something to do with demand, especially in this uncertain environment, so shares are down this morning. Now, the final stock, Lisa, you mentioned this one, Carvana, a really solid set of earnings from the used car dealer. Profit doubled. It also saw record vehicle volumes, and at the same time, its loan sales went up too. Now, there's this idea that there's been a pull forward, cars are going to get more expensive because of tariffs, but the CEO saying that this is something that might last, because if new cars are more expensive, more people will be turning to marketplaces like Carvana for used cars. So those shares up just under 6%, John.
Danny, appreciate it. 3 of the movers in the pre-market. Danny, thank you very much. More from Danny in the next hour. On our radar this morning, our top story, President Trump announcing he's made the first of many trade deals. Trump posting on Truth Social, this should be a very big and exciting day for the United States of America and the UK. The press conference at the Oval Office, 10 a.m. Eastern Time.
3 major questions, in my opinion, around this particular announcement, other than just what the contours of this looks like. Will the 10% baseline stick? If it doesn't, does that mean that there's actually a new floor in terms of, or new ceiling for how high tariffs necessarily will be? Second one, with our movies. A real question here around the ban or the extra tariff on movies coming from overseas, given the fact that the UK is actually a significant source of movies of where they are filmed from the United States. And the third one is, how does this complicate things for the Bank of England, which has to act 3 hours ahead of this announcement at a time when there is a great deal of uncertainty around what the future of trade agreements will look like?
I think they were going to cut rates anyway. I mean, we'll find out what the UK does a little bit later this morning. You said movies, I'm thinking autos. This isn't the only bucket of tariffs that we've got on at the moment. It's not just about the 10% baseline. You've got tariffs on steel and aluminum. You've got tariffs on autos. And the auto piece of this is going to be so important for other countries that are in the line for trade deals. Japan, South Korea. Anne-Marie has talked about this a lot. It goes beyond just that 10% line in the sand.
Yeah, that has to do with what other tariffs there are in place. I just wonder again, and we have to keep going back to this, how much the UK is a template for other countries, or whether some of these sectoral tariffs will selectively be taken out for certain countries and not for others. It is so confusing to get your head around this, which is the reason why people are just looking and hoping that maybe we get some more clarity.
Heading into the weekend for negotiations with China, China reiterating this, calling for the US to cancel unilateral tariffs ahead of the weekend's trade talks. This coming after President Trump said he's unwilling to lower levies in order to jumpstart negotiations. Both of them playing hardball going into Switzerland.
Yeah, hard to know how much is noise and how much is signal in terms of what this means about just even coming to the table and de-escalating some of the pressures. I also am struggling to understand the so-called AI diffusion rule that President Trump got rid of, the Biden-era chip restrictions that really prevented the likes of NVIDIA from selling chips not just to China, but other trade partners above a certain level because they didn't want those chips making their way into China. A real question here, is this an easing in the pressures? Is this not? Again, such a lack of clarity, not only in the signaling, but also in terms of just what the contours of some of these restrictions are going to be.
Try to run a business in this environment is difficult, particularly for the car makers. Look at this, Toyota forecasting a $1.3 billion profit hit from tariffs in just 2 months. Ford raising its sticker prices on Mexican-made models by as much as $2,000 after saying it expects a $2.5 billion hit from tariffs this year alone.
So last week, Jim Farley, the CEO of Ford, came out and said they're not going to necessarily raise prices right away. They have to watch what competitors do before they understand exactly how much consumers are willing to absorb some of those costs. And then, in a memo seen by Bloomberg, it was apparent that they were increasing their car prices by as much as $2,000. What does that tell you? These are ones that are made in Mexico. They have extra costs. They are teasing the market, and they are going to tease the market probably with things that are higher price vehicles where they have more give. And you can start to see this play out in a market in real time, which is the reason why I'm watching CPI next week, which is the reason why inflation reading is going to be so important, because it could start to creep in as soon as the next few weeks.
The president is teasing Chairman Powell at the moment. I think we've got this post ready for you. Let's bring it up. Too late, Jerome Powell is a fool who doesn't have a clue. Other than that, I like him very much. Oil and energy is way down, almost all costs, groceries and eggs are down, virtually no inflation, tariff money pouring into the US. The exact opposite of too late. Enjoy.
What this signifies to me is that somebody told President Trump to tamp down the rhetoric around firing Jay Powell. And this is almost downright an endorsement because, frankly, considering the termination concepts that you'd had before.
Is that how low the bar is?
That's how low the bar is, yeah,
You're
absolutely.
saying this is him playing nice?
100%,
okay.
absolutely. Because this is essentially trying to make the argument the economy is pretty good. You know, he's going to do what he is going to do. I like him. And oil, you know, check it out.
I guess everything's relative.
I mean, am I wrong?
This is the president playing nice, yeah. Relative to firing him.
Exactly, 100%.
Sure, anything's nice relative to terminating his contract.
You know, he didn't say, well, he said a fool, but whatever.
Okay, that's the latest from the president. As Lisa mentioned, the Trump administration planning to rescind and replace some Biden-era AI chip curbs. Officials looking to offer opportunities for some countries to negotiate their chip access. Bloomberg's Tom McKenzie joins us now from London to explain all of this. Tom, welcome back to the program, buddy. I think we have to start with the so-called diffusion rule. Let's start there. Yeah. Just explain what that is and why the president doesn't like it.
Yeah, the diffusion rule, or the traffic light system, where you have US allies, so you can think of the UK, Australia in one bucket, the green light. Those in the middle, those neutral countries, that's amber, of course, so the likes of the UAE and Saudi Arabia, and then, of course, the adversaries of the US, so China and Russia in the bottom bracket. They do not get access to the most high-end AI accelerators. Those at the top bracket, of course, and the green light do get those free access, and those in the middle get a restricted list. They have to apply for licenses, and they get a restricted number per year. That rule set to kick in May the 15th. As you say, they are now looking to repeal that law. They haven't done it yet, but they're not expected to enforce it if it kicks into place. The timing is really interesting because it comes ahead, of course, of Trump's visit to the Middle East, to the UAE, to Saudi Arabia. And we know those countries have been very angry about this Biden-era restriction. We know as well, corporations like NVIDIA, Jensen Huang has been very clear about the impact of this rule, as has AMD as well. So there's been the corporate pressure and, of course, on a national state-level pressure on Washington to adjust these rules. The debate is still there. This is not about easing up the pressure on China. The focus is still on those third-party countries that some say have allowed the shipments of some of these top-end AI accelerators into China. Think Malaysia, think Thailand.
Yesterday, we saw NVIDIA shares up more than 3% on the backs of this. This is what the Commerce Department had to say when there was this potential repeal of this diffusion rule. The Biden AI rule is overly complex, overly bureaucratic, and would stymie American innovation. We will be replacing it with a much simpler rule that unleashes American innovation and ensures American AI dominance. Tom, would this rule be more black and white, just a red light and a green light, like Scott Bessent was saying yesterday, and actually more stringent? Do we have any sense of what that could look like?
Yeah, and Jensen Huang as well, NVIDIA putting out a statement saying they welcome this change, and we're still waiting for what the details will be. But it seems like it could be another tool using these AI accelerators by NVIDIA, by AMD, another tool in Trump's arsenal when it comes to these bilateral negotiations with countries. If you are the UAE and you commit to over $1 trillion of spend on infrastructure in the US, does that open the door to having more access to these AI accelerators? The same conversation around Saudi Arabia. Arguably, that's the way to look at it. This is another tool in the arsenal of President Trump. Whether it makes it less complicated, I think, is a key question. The assessment from some is that, in fact, it will become more complicated, more difficult for these companies to navigate around this. And a reminder, of course, Howard Lutnick has said he's going to take a tough line in terms of AI accelerators into the Chinese market, particularly on the back of DeepSeek. And, of course, we saw NVIDIA writing down, what, $5.5 billion when the H20 chip that they designed specifically to get around those curbs was also blacklisted by the Trump administration.
Hey, Tom, appreciate the update. Thank you, sir. Tom McKenzie over in London. NVIDIA this morning positive by 1.65%. We are all in wait-and-see mode, including the Fed chair, Jay Powell. Claudia Sam of New Century Advisors writing the following: I agree with the Fed's decision to hold rates and flag the risk of higher unemployment and inflation. However, it was a missed opportunity to lay out how it plans to decide whether tariff-induced inflation is temporary. Claudia joins us now for more. Claudia, welcome to the program. Let's build on some of that. What would you have liked to hear specifically from the chairman in that news conference?
I'd like to hear their framework, what kind of data they're looking at, how they're going to move back into some forecasting, right? Like what is it they're going to use to, it's clear that the Fed, or at least Powell, they're not embracing this. It's the textbook case. Inflation, when it's because of tariffs, it's temporary. Now, we do hear Governor Waller making that case. We got to be brave and it's temporary. We need more than that, right? Like, what are they looking at in the data? And this is where I think looking more broadly, not just the CPI, the labor report, but how are they using all these services of business, or surveys of businesses, the surveys of consumers, that soft data that seems somewhat maligned. Like, what are they going to use to make that decision? And I know that they must be doing that work. It's just, I think sharing more of that before we actually get to the position where the dual mandate is in conflict would really be helpful as a guide.
Claudia, do you agree with Fed Chair Jay Powell that there isn't that big of a cost to waiting?
The Fed's tools work with a lag, so like there are costs to waiting. Now, I agree that at this moment it's too fluid, right? And this is a historic shock that is facing the economy, and businesses are just starting to work through it, and it could go in a lot of different directions. So again, I understand why this is a moment where, holding makes sense, and yet, like, there are costs to waiting. And I think one of the issues I really took in the press conference was Powell, reinforcing, well, but the data are fine. The inflation's fine, the unemployment's fine. The data are not fine, right? If we look at, say, into the first quarter GDP, that surge in imports, that is telling us this is a really big shock that's coming at the economy. This is out of expectations. Businesses are pulling in, rushing imports, probably building inventories. That all comes at a cost. And remember, what we thought in the first quarter was going to be the tariff increase, it's actually worse now. So, it's already here. People are changing behavior. No, it's not in CPI. No, it's not in the unemployment rate yet, but it's coming. So, prepare. You can wait, but you really need to be prepared.
There was another aspect of this press conference that I found particularly interesting, and it was when Fed Chair Jay Powell said that the 2024 rate cuts were not preemptive. If anything, it was a little late. And of course, this is referring to the unemployment rate that had increased by 0.5 percentage point, as the Somm rule dictates, your rule. And they did respond, and then some of that data was revised upward, actually. What did you make of that comment, that if anything, we were a bit late?
I don't think they anticipated going straight up with 50 basis points. I think the 50 basis points was a catch-up, that they should have started one meeting earlier. I think that's the lateness, because they weren't reacting to the bottom falling out. It was we don't want to see further weakening. So I think the Fed probably would have preferred to have had that in more spread out in like 25 basis point increments. But I think that's where it came from. But that's such a fine point on timing. So I can understand why that's seems a little muddled.
I think it's important to go back over it, though, Lisa. I'm pleased you brought it up. We've had so many guests say this Fed is willing to be late, and we're all struggling to define what late is to the Federal Reserve. If last year was late, I think the market would take that. Is that late? 100 basis points in the summer, little drift higher in unemployment?
Yeah, if that's late, that is the most dovish message you could possibly send, because that means that being late means being on time for a lot of other people. That seems to be my take.
Claudia, you're one of the best, always clinical. Appreciate your time. Claudia Sam there of New Century Advisors on the inflation situation. Claudia's right. The effects on inflation could be short-lived. The effects on inflation could be more persistent. Heard that from the chairman yesterday. How will they know? How will they know the difference between the two? At what point? How long does it take to find out?
When do we get a sense of the reaction function to your point of view? It was interesting, as Bob Michael pointed out, that the transitory word seems to have been retired. At least it's been packaged back up and put back on the shelf. It was not repeated yesterday. Wait and see is the new word of the day, and it seems like they are not willing to commit to believing that it is going to be something that only will be a passing trend.
It's got a new wrapper.
Yeah, what is it?
Short-lived.
Short-lived?
Yeah, not transitory anymore.
Think so?
Change.
I think it's just wait and see. Honestly, I keep going back to this Blake Wynn email. I learned this note that he wrote where he said the epitome of this meeting was the epitome of this could have been an email, which was just a subject line that just said, wait and see.
We've seen that a million times. Wait and see, wait and see. We've got to wait and see. Let's get you some stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. President Trump continuing to criticize Fed Chair Jay Powell for not cutting rates. In a post on Truth Social, the president calling the Fed chair too late and saying he doesn't have a clue. Trump went on to say, other than that, I like him very much. Meanwhile, HSBC is offering a new loan product to U.S. companies struggling to cover the costs of President Trump's tariffs. The bank says it's extending its TradePay platform to directly cover the cost of increased expenses involved in shipping products into the U.S. And the Champions League final is set after PSG eliminated Arsenal. PSG sealed a 3-1 aggregate win in front of the home crowd and now has a chance for redemption after the heartbreak of the final 5 years ago. They'll be facing Inter Milan at Allianz Arena in Munich. The match for the trophy is set for Saturday, May 31st. That's your Bloomberg Brief. John?
Very, very cool. Looking forward to it. Yahara, thank you. More from Yahara in the next hour. Up next on the program, the Fed's new motto.
For the time being, we're well positioned to wait for greater clarity. We await further clarity and waiting to see further. We have the ability to wait and see. That's why we're waiting.
That's why they're waiting. Kelsey Barrow of JP Morgan Asset Management weighs in next from New York this morning. Good morning.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done.
by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
A statement from the President of the United States already this morning saying the following: engaging in talks with the UK and writing this. The agreement with the UK is a full and comprehensive one that will cement the relationship between the United States and the UK for many years to come because of our long-time history and allegiance together. It is a great honor to have the United Kingdom as our first announcement. Many other deals which are in serious stages of negotiation to follow. And that's why this market is trading near session highs. On the S&P 500 right now, on the S&P we're positive by 1 full percentage point. On the NASDAQ, up by 1.4. We've all got to wait and see. Under surveillance this morning is the Fed's new motto.
For the time being, we're well positioned to wait for greater clarity. We await further clarity. Wait and see. Wait and see. Waiting to see further. Wait and see. Wait and see. Wait and see. Waiting to see. We simply have to wait and see. We'll just have to wait and see. We have the ability to wait and see. That's why we're waiting.
That's why he's waiting. Fed Chair Jay Powell saying the Federal Reserve is positioned and committed to a wait-and-see approach. Kelsey Barrow of JP Morgan Asset Management writing this: we expect the Fed to look through tariff-related inflation so long as it is perceived to be a one-time price level reset, but this will take time to determine. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
That's my question. How long does it take to understand whether this is short-lived or persistent? What defines that?
Yeah, it's a difficult question, and Chair Powell was asked that exact question, and he didn't give a lot of guidance on that. I don't think he ruled out a cut in June, or I don't think he ruled out really anything. He created max optionality for himself, which he's become very good at doing. I mean, if anything, I look at the reaction of the bond market to the meeting, and I think it's spot on exactly what he wanted, which is very little movement at all. So kudos to him. Let the policy and the shifts in policy drive the bond market, not the Fed right now, because just like the market, the Fed is waiting for more guidance on what's coming next.
Let's build on that. You went to the bond market. What's its signal about that debate about whether it's short-lived or whether it's more persistent? There are different ways to gauge inflation expectations, survey methods, market-based expectations. What's the market signaling?
To us, it's pretty clear. The market is signaling that this is going to be short-lived. And the repricing within the inflation market, tips, break-evens, as well as inflation swaps, has been very efficient. Efficient meaning that the inflation impact is really concentrated to the next 12 to 24 months. And then beyond that, you're seeing very little impact. If anything, the market is pricing in a probability that beyond the next 12 to 24 months, inflation actually falls below target. Because ultimately, what we're thinking about here is, what are tariffs ultimately? They're a tax on the consumer, they reduce demand, and ultimately that's something that weakens the economy, weakens prices, not the other way around.
I'm looking at the cuts that other central banks around the world have made since the middle of last year. The ECB, 175 basis points. The Bank of Canada, 225 basis points. After this morning, the expectation is the Bank of England will have done 100 basis points like the Federal Reserve. Is there a world
in which it could be disinflationary, these tariffs, for the entirety of the developed world, but not the United States?
In the short term, probably, but in the longer term, I do think that you are going to see the negative demand impulse overwhelm the short-term impact of tariffs. But I think it's really interesting what you just said, highlighting that other central banks around the world are continuing with their easing policy. I was just checking before I came on today what the return on the global bond index is year to date. So the U.S. Ag is up about 2.5%, pretty respectable given the volatility, so still working as a diversifier in your portfolio. The global Ag is up 5.5% year to date. Right? I think people really underappreciate that there's quite a lot of opportunity outside the U.S. in terms of developed bond market, government bond markets, and also other central banks. The trade-off is much less ambiguous. It's much more clear. Both the growth aspect and the inflation aspect are telling them to continue to cut rates, which is what we expect the BOE to do at 7 a.m.
This is the reason why the wait and see for Fed Chair Jay Powell is a reason that a number of investors around the world are increasingly looking elsewhere other than the United States, because wait and see is not a good strategy for investors in a lot of ways. Steve Major over at HSBC said this morning, we prefer taking duration exposure in the U.S. and stay neutral on U.S. Treasuries as they wait for some of the policy uncertainties to subside. Do you agree with that? Is that kind of what you're thinking?
Yeah, so I would say in general, I think longer dated yields are somewhat range bound here. We've had a range for the 10-year Treasury of around 375 to 450. So we're on the higher end of that range. And what that means is that there is some asymmetry there. For example, if we did see an increase in initial jobless claims at 8:30 this morning, we would expect, there is significant room for yields to move lower, for the market to price in a more aggressive Fed cutting cycle. But in the near term, I think that the market has been fairly stable. It's been consolidating in a narrower and narrower range. And ultimately, what's going to break us out of that is going to be an indication on policy, whether it be fiscal policy or trade policy. I think that one of the things that is going to become more of a focus, so far trade policy, we had the escalation aspect of it, and then when is the escalation going to stop? We got peak escalation, then we are on the de-escalation train. What I think people need to start focusing on is where are we going to end up? What is that effective tariff rate that we're going to settle at? The negotiations today with the UK are going to do essentially nothing to change that effective tariff rate. It is still on track to be extraordinarily high. So while maybe this is good news, I'm not necessarily sure it's a roadmap for the rest of the world. And really what will be driving sentiment in the market as we turn to the next week will probably be more likely the negotiations with China over the weekend.
Kelsey, appreciate the update and the reaction. Kelsey Barrow at JP Morgan Asset Management, framing things, I think, quite well. If the first deal is with the UK and we expect the announcement at 10 a.m. Eastern Time, it will be the easiest deal compared to, say, China and the negotiations over the weekend.
Which is a reason why potentially the rhetoric around the talks about talks might end up being more important.
The second hour of Bloomberg Surveillance up next. We'll catch up with Gargi Chaudhry of BlackRock. More from Anne-Marie down in Washington, D.C., Nouriel Roubini of NYU Stern, and we'll speak to the former Kansas City Fed President Esther George from New York City this morning. Good morning.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past
to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
The tariff increases announced so far have been significantly larger than anticipated, and their effects on the economy remain highly uncertain.
How do they assess then what the impact of tariffs will be on the economy if they don't have the tariff rate?
The probability of recession has gone up. I don't think, anyway, that the Fed's going to be cutting to try to get ahead of that.
Our recession scenario is 60%.
The whole theme everybody's been talking about, and Powell answered in multiple ways, is we don't know, and he doesn't know, and it's heightened uncertainty.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Equity markets right now, your scores look like this. Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P higher by more than 1 full percentage point. That's the S&P on the NASDAQ up by 1.5. The Y, plenty of Ys, but the main one is this one right here. The President of the United States teeing up 10 a.m. Eastern Time. The agreement with the UK, a full and comprehensive one that will cement the relationship between the US and the UK for many years to come. And the hope of this market, it's the first of many.
And it sets a template of some sort in terms of how far the U.S. is willing to go to negotiate and bring down that 10% floor potentially for tariffs. Raises a question, how much is it actually a template, given that it actually is a pretty good relationship between these two? Nonetheless, it is important to see the very first of trade deals at a time when President Trump says there are many to come.
And if I'm a trade partner looking at how this is playing out, I want to know what is negotiable and what isn't. The baseline tariff, 10%. Can we dial that up and down? The tariffs on autos, can we move that? The tariffs on steel and aluminum, are they negotiable too? Important signals for other people set to follow to go into the White House and make these kind of deals.
Yeah, and unclear whether we're going to get those signals completely, because this will be more the contours of a deal and it takes much longer. But you're right. How significant is it that this is coming ahead of the talks this weekend with China at a time when that ultimately is the real question mark for a lot of people, how that trade tension gets resolved?
It's difficult to make central bank policy decisions in this mix, isn't it?
Wait and see.
Can change like day to day.
Wait.
Wait for 30 minutes and you might get a trade deal. Wait a few hours and you'll hear what the US and UK has in store for you. Wait for a Bank of England rate decision. We'll get to that in just a second. Coming up this hour, we'll catch up with Gargi Chowdhury of BlackRock as President Trump teases a major trade deal. We'll speak to Nouriel Roubini of NYU Stern saying no pain, no gain for the US economy. And we'll catch up with the former Kansas City Fed President Esther George on the Fed's wait-and-see approach. I promised you an update on the Bank of England. We begin this hour with another